Welcome, those of you who've just joined. We anticipate quite a large gathering today, so the time we'll start will be a little after 2 o'clock, so you have a little bit of time to get some coffee or tea or whatever you want to do, have some lunch. But I would imagine the latest we'll start is 2:05. If the if we have the numbers before that, then we'll start a little earlier, but aiming for about 2:05. So welcome and look forward to seeing you in a moment. Well, welcome to those who've just joined again, and to those who've been with us for a little while. We will be starting at about at 5 past, just to give those that are in traffic a chance to. The internet seems to be a bit slow today, so give those a chance to join. But we will start at 5 past. That just gives you an opportunity to get your snacks or your coffee or your tea ready, and see you in a moment. Okay, another welcome to those who have just joined. We will be starting in 2 minutes' time at 5 past. So prepare yourselves if you need to get anything ready, and we'll begin at 5 past. Thanks. Final welcome to everyone for joining us, and thank you for joining us this afternoon. We are privileged to have Professor Jackie Arendse with us, and so it looks like an interesting afternoon. As great Tom Peters once said, if you're not confused, you're not paying attention. So, Jackie, we're relying on you to clear the clutter and clear up the confusion. And I'm not going to say any more. The floor is yours. I wouldn't dare to venture into this discussion, so I'm leaving it all to you. And thanks
Uh,
everybody for joining us. And Jackie, the floor is yours.
Thank you so much. Good afternoon, everybody. Hope you can all hear me okay and that you can see the slides. Yeah, it's a great pleasure to be talking to you again about the budget speech. Well, yeah, a budget speech like we've never had before. And I guess, yeah, some people are seeming to be relieved that we actually have a budget speech. And that certainly would not be a concern that we would ever have thought about in the past. But nonetheless, we have a budget speech that has been tabled. We are now in the very interesting phase of the discussion process leading up to the actual final tabling to see whether we actually get parliamentary approval of this budget. Yeah, so it's going to be a very interesting time as we go forward. But let me focus on more pressing issues, and that is when you're going to get a break. And so we'll start now and we'll run through until say 3:30, and then I'll take a break at 3:30 for say 15 minutes or so. And then we'll go on from 3:45 through until just before, well, we're scheduled to finish at 5 o'clock, so we'll be done by 5. Okay, so yeah, we're in for a very interesting time this afternoon, interesting discussion. Of course, I'm going to be focusing on a little bit of the economic context of the budget so that we can have that in our minds as we then go on and have a look at the tax proposals in the budget speech. And as I go along, well, we'll talk about the finality or lack of finality, lack of certainty as far as these proposals are concerned. But before we get too far down the line, let me also just mention that if you do have any questions, you are welcome to raise those. Now, I will have a look at the chat from time to time, but just bear with me. I'm not going to be distracted by the chat. I'm going to keep going. And what I can always do is just pick up whatever the questions are in the chat box at the tea break. And then, of course, at the end, we'll pick up any remaining questions. All right, so let's get straight into it then. So a little bit of the economic background to the budget, because it is always, of course, important to think about what is the context for this budget and, where are we now? I mean, there's been so much said about this budget speech that I'm sure much of this is not going to come as a surprise to you. But I think just to sort of put it front and center, to bring all of our focus areas into one place as we go in. So I've got here the kind of snapshot, all right, revenue and expenditure. As accountants, that's what we're interested in. Bottom line, profit or loss. Well, unfortunately here we just see a deficit all the way along. But I think what I'm trying to show on this slide is a little bit of a trend. So going, the last few years into this year. But then I'm also showing the comparison of revenue and expenditure, obviously, in relation to GDP, and also looking at GDP growth and CPI, our inflation rate. And then also what I want to have a look at is how does our current year's estimate, so if we go over here, 2024-25, the revised estimate for this year. So this is the estimate for this current fiscal year that we are still in, because government's fiscal year runs through until the end of March. So for this year that we're still in, this is the latest estimate as was tabled on the day of the budget speech, okay? And how does that compare with what we were given in the budget speech last year? Because we have seen a little bit of a trend over the last few years that what is tabled in the budget speech as far as revenue expenditure estimates are concerned sometimes turn out to be a little optimistic. So we'll just have a look at that, and then we'll have a look at what the estimate is for next year. So if we look at revenue, since 21, 22, and then 23, 24 through to this year, and then on to next year, So revenue, you will see, has obviously increased every year, and it's an important measure is that revenue as a percentage of GDP. Now, this revenue is the actual total gross revenue. It's not just tax revenue. So this is not our tax as a percentage of GDP, but nonetheless, much of this is tax, of course. And so this does give us an idea of tax in relation to GDP. And of course, this number looks rather high. And yeah, it certainly has stayed high all the way through. What is interesting is that if you look at the revised estimate for 2025, well, first of all, you'll see that it's significantly down on what was budgeted for. So it's kind of 7 billion rand less. So we didn't come out as well as we thought we would at the time of the budget speech last year. And that means that a percentage of GDP has also gone down a bit, all right? Nonetheless, government expects that to bounce back, which is not a good thing for us, because if this comes from taxes, it means this is out of the pockets of consumers into the hands of government. But they're looking at revenues going to go up next year up to, that's 2.2 trillion rand. Okay, and that'll make up 27.8% of budget, which is a very high number, the highest it's been since 2023. And it remains to be seen. Of course, that is just the estimate for next year, going through to the end of March 2026. And there's so much uncertainty, not just in South Africa, but in the world at large. It really remains to be seen what we end up with there. But then, of course, what's important to look at is expenditure in relation to revenue. And this is the big crunch point here, is that every year our expenditure is more than our revenue. And I know I've made this point with this group a number of times, and that is that, you know, if this was your own business or your personal finances, there's no way you would just keep going relentlessly year after year where your expenditure is more than your revenue. I mean, at some stage you'd have to rein something in, because we all know that you can't just pull revenue out of thin air. You can't just grow revenue. Let's just leave the expectations of government to one side for the moment. But generally speaking, you can't just grow revenue. So if you are sitting with a deficit like this, what you can manage should be your expenditure. And yet the focus of government on budget, and this year and even in previous years, seems to be that they're trying to see how they can grow revenue, while expenditure just seems to inflate all by itself, just gets bigger and bigger and bigger every year. So if you look at expenditure as a percentage of GDP, you know, 32.4, 31.7, and then hovering around that mark. And then the actual revised estimate for 2025, 32.1. At the time of the budget last year, they were expecting it to be 31.8% of GDP, and now it's gone up to 32.1 without any real specific and clear explanations. We've just seen this expenditure number grow by sort of 35 billion rand. That's a huge amount of additional money. And of course, that's flowed through to what was told us at the first version of the budget, that they needed this extra 60 billion to fund additional government expenditure. But of course, I don't need to tell you that what we need to focus on is reducing the expenditure, at least managing this expenditure, not just looking at constantly clamoring to get extra revenue to cover the expenditure. Now, if you look through to next year, here again, quite a significant increase, and this is as a percentage of GDP. So given that we think GDP is going to grow a little bit, and little being the word, but this is saying that relative to GDP, expenditure is going to grow. So it's going to go from 32.1 up to 32.4% of GDP. It's going to go up another sort of 188 billion rand between this year and next year. So to me, that is extremely concerning. And I think that's one of the biggest disappointments of the revised budget speech, is that we did not see any really clear ideas and focus areas as to how this expenditure is going to be managed. So, yeah, there was quite a lot said, but what really came through is a clear, concrete plan to manage government expenditure better, in my mind, was certainly absent from the budget speech. And it's it's a huge concern, and that is the big concern that's now coming through as this goes through the parliamentary discussions, and the other political parties other than the ANC saying that they're not going to support this budget speech. It's really around, we can't just say it's just because of the VAT. It's not just because of the 0.5% VAT, or, it was 2%, now it's 0.5% this year. It's not just that. It's this whole lack of focus on the expenditure side of the budget, and even more concerning, this lack of focus on how to grow GDP by some meaningful number, that we can't just be wallowing along with GDP barely growing. When we know our population is growing, we know our expenditure needs are growing, and yet there seems to be this acceptance from government that GDP is just going to wallow along at the prevailing growth rates. And you'll see the growth rates shown over here, and I'll show you a table, a graph on the next slide. So we're sitting with anticipated GDP growth for this year around 1.1%, 2025, and then next year about 1.8%. Well, that 1.8, is it really going to be achieved? What has really been put in place to see a real growth in this economy? It's the age-old saying is that if you're standing in a bucket, you can't pull yourself out of the bucket by pulling on your shoelaces. And the saying is that you similarly cannot tax an economy out of a recession or out of a low growth scenario. So we're sitting in a very low growth scenario here, and there seems to just be a focus on how to increase taxes, but not really a focus on how to build this economic growth. And without building economic growth, we're just going to go nowhere. We're just going to carry on going over this fiscal cliff. And of course, the thing is that if you build economic growth, I don't need to tell you this, you grow your economy, that's going to grow your revenue base, and then that will produce extra taxes. So really, this should be the prime focus of the budget. That should be what it's all about. What are we going to do to grow this economy? Now, CPI inflation I just put in there because it's also important to bear in mind that we do still have inflation. It hasn't gone away. It's certainly lower than it used to be a decade ago and so on. It's lower than what we thought it would be this time last year. It's coming out at 3.9%. And then the expectation from government, it's going to go up to 4.7% next year. So inflation is very real. And so when we talk about later on the proposals around the personal tax tables, freezing those personal tax tables, rebates, medical credits, we have to remember that that's in an environment where we do have inflation. And household inflation is certainly more than this general inflation rate. So, people's earnings have to be increasing if they are able to keep pace with the cost of living. But increasingly, more and more South Africans are having to manage without inflationary adjustments to their earnings, which means that they're getting poorer year by year. But what we have seen is that there was this 3-year wage deal put in place. It was finalized about a month ago, sort of making sure that all the civil servants will get above inflationary increases over the next 3 years, which is also what's feeding into this additional expenditure that's coming through here. So, just a sort of lot of information on that slide, but I think it really encapsulates so many of the key aspects of the economic context that we need to think about when we evaluate this year's budget speech. Now, I was talking about economic growth, and towards the end of last year, or actually this report came out in January this year, Stats SA put out this report around our economy over the last, 30 years, from 1994 all the way through to 2024. At that point, they were anticipating that we'll see a 0.6% growth in 2024, all right? According to the numbers in the budget speech, they're expecting that to be 0.7%, but nonetheless, end of last year, Stats SA was reporting it at 0.6%. Whatever that case may be, I think what we really want to focus on here is the trend around economic growth. Okay, it's up and down, but there's only 2 years where we've actually seen negative growth, as it were, shrinkage. The one was in 2009, and that was immediately after the financial crisis of 2008. And then the other was a much bigger shrinkage, and that was in 2020, of course, as a result of COVID and the economic catastrophe that resulted from COVID. But apart from that, we have seen growth, albeit very low. But my concern is, we're just seeing this coming all the way down now, 0.7, 0.6, maybe kind of kicking up a bit to 1.8, 1.9. But that's certainly not enough growth to produce the kind of economic output, or to produce certainly the tax revenue that we need to sustain this country, bearing in mind that the population is growing, the government expenditure is there and is growing. And yeah, we are taxed to the hilt. The only way we are going to get more tax revenue is by growing the economy. Now, my question is, we are sitting down this end over here. Why are we not able to get back up to these growth points that we saw before COVID? And this is really where economists tell us that we need to be, is in the sort of 3 to 5% or above, if you really want to start seeing something positive, bearing in mind that we also, and the other key statistic in this country is our 40% unemployment rate. So if you're sitting with very little economic growth, high government debt, which we'll come to just now, and extremely high unemployment, we have to grow this economy to provide the means for South Africans to be able to be themselves economically active. So the question really should be, and this should be our focus, and this is where we need creative minds. I mean, there's no shortage of good minds in South Africa. I always say what we need is implementation, but nonetheless, we really need some great ideas that can be implemented to see us getting this economic growth back up to that sort of 5% that we have seen. It's not as if we can't do it. We've done it in a number of years over the last 30-year period. We just have to work out how we can get to those levels once again. What is interesting is that in the Stats SA report, they were looking at the different government sectors and which ones were showing growth during 2024. And of course, we see here the finance, real estate, and business services sector, and the electricity, gas, and water. Isn't that ironic? That's where we saw growth coming through in 2024. Personal services, and then mining and quarrying to a much lesser extent. We saw manufacturing shrinking in 2024, which is very concerning, especially when you think about how our tax system is so much favoring or designed to favor and provide incentives for manufacturing. Well, manufacturing and finance, I think, are the sort of two areas that our tax system seems to really be geared towards enabling. And yet manufacturing has shrunk over the last year, as has transport, storage, communication, trade, catering, accommodation, construction, significantly 5% down. A very, very concerning number that. When you think that any economy that is developing would have to have construction going on, construction of infrastructure, construction of housing, so we could go on, and to see construction actually shrinking in 2024, extremely worrying. Agriculture, forestry, and fishing shrank in 2024. One little bit of glimmer on the horizon is that in the last quarter of 2024, we did see growth in that sector. But I think if you look at our different business sectors, it really paints a rather dismal picture. And especially in my mind, if I look at finance, real estate, and business services growing by, well, 3.5%. But the thing is, if that's growing by 3.5%, it's probably on the back of these other sectors that are shrinking, having to borrow more money, pay interest, etc. And so that growth is at the cost of these sectors that are shrinking. And so overall, as we saw, only a 0.6% increase in GDP. That's a real increase, okay? That's without taking into account inflation. That's the real increase in the economy. So very, very concerning. And really, I think, we don't need more tax incentives. That's not what I'm suggesting at all. I'm not suggesting we have more tax incentives. We need other ways. And of course, it starts with investment in infrastructure. It starts with proper management of resources. It starts with cutting out corruption and wasteful and fruitless and wasteful expenditure, and making sure that our money is actually producing value. Then we would be able to see the economy turning around. But it really requires really serious intervention and attention. We're not short of money in South Africa. We are short of implementation, proper management, and proper accountability. So these three industries that grew in the fourth quarter of 24, I just put that just for an interest sake. There's the agriculture coming through in the fourth quarter, it grew. All right, as did trade, and there's finance once again. Everything else didn't do too well in the fourth quarter. What I also find interesting in the fourth quarter, of course, that did have a fair impact on the economy was the two-pot retirement system going live from the 1st of September 2024. And then, of course, that resulted in some 45 billion rand being taken out of retirement funds and invested into the economy. It was expected that that would produce quite a good sort of injection into the economy in the fourth quarter. But we haven't really seen it coming through, maybe just to a small extent. But of course, the expectation is that most of that money that came out of the retirement funds probably went to pay off debt. But then there was also quite a significant amount of it that was supposedly used for important expenditure of households like school fees, school uniforms, etc. And then, of course, you know, just the day-to-day things that people need. There was a small amount, of course, that may have gone on extravagant expenditure, holidays, clothing, shoes, whatever the case might have been. But yeah, that was sort of spread around the economy. But it certainly would have fed into the end result for the fourth quarter. But it's not as if we suddenly saw a fantastic growth in the economy as a result of that. And what really concerns me is that that 45 billion is now out of the retirement funds and it's gone to wherever it went to pay debt, etc., etc. It's not as if to say all the members who took that money out of their funds that they're now in a much better financial position. And the question is, what position will they be in 10, 15, 20 years down the line when those people come to retire? And if they keep taking their money out of the retirement funds, if they keep taking out their savings component, where are they going to be when they come to retirement age in terms of having enough retirement capital to fund them through their retirement? You know, retirement is another really interesting aspect because, you know, the statistics show us that people are living longer, and yet we still have this mandatory retirement age of 60, 65. Apparently, the socioeconomic experts tell us that that retirement age was set decades ago when people's life expectancy was much less than it is now. And in fact, the suggestion is that perhaps the retirement age should go up. People should work for longer because they just will not have enough money to see them through retirement. But let me not digress too much. I think the key point that I'm making here is that the money that came out of the retirement funds as a result of the seed capital through the two-pot retirement system may have some negative implications for the individual workers who ultimately will get to retirement age. And the question then will be whether they will have enough capital to retire on. So see, I've got two questions here. George, understand the IT3 submission. Oh, goodness, you really are taking me off on a tangent here. Yeah, trusts next year, it's going to go back to May, it would seem. SAICA has made a submission on that, so it's going to be interesting to see what they do. SAICA certainly has indicated that they're hoping that that will be extended. And then Shirley has said two-pot retirement withdrawals, more social grants to come in the future. Yeah, Shirley, unfortunately, this is what's going to happen, I fear, is that we just have more and more people relying on government support. We already have apparently 28 million people relying on social grants. And if things carry on like this, we just end up with more people relying on government. And of course, I shouldn't say a government, it's the taxpayers who have to fund that, right? And we'll look at the number of taxpayers just now. But of course, the other aspect with government, with the economy of South Africa, I've looked at revenue, expenditure, the deficit, and the lack of economic growth. And the other huge gorilla in the room is government debt. And of course, government debt, you know, I remember that years ago, even when Pravin Gordhan was, the late Pravin Gordhan was finance minister, and this question was raised because we had started, when we changed over from Trevor Manuel. In fact, if you look at this little graph down at the bottom here, which shows us government debt as a percentage of GDP. So coming down to sort of 2008, 2009 is when we were at our lowest level of government debt as a percentage of GDP. And that was literally at the end of Trevor Manuel's reign, and look, I'm not suggesting it linked to the individual, there were a lot of factors that came into play. But as our government debt started going up and the questions were put to the finance minister at the time, is this not starting to look rather concerning? And the answer was no, it's fine. We can handle this, and we need to borrow in order to fund the increased expenditure and so on. But as we've seen government debt going up and up and up, and now up to sort of 75, 76% of GDPs, when you look at these rates over here. Now, is that a high percentage? Is it a percentage that is too high? Well, different people have different views on this. Some people would argue that even going up to 100% of GDP is not a problem. Well, whatever that percentage is, I think my concern is what it's costing us, because, you can borrow, but ultimately you have to repay and you have to pay the interest on the borrowings. And if you think about it, the cost of servicing the debt that we are paying now, this is expenditure that we are having to take out of our budget every year. And it's really servicing money that we've already used in past years. So whatever we were going to buy for that, that's all gone. All right. It's gone on wages. It's gone on who knows what all over the last number of years. And yet we are still sitting with the debt service costs. And this is always the concern with debt, right? I mean, debt has a role, obviously. You can use debt cleverly, but you have to bear in mind that you have to pay for that debt. And you've got to think about how you're going to pay for it and whether you're going to have a sufficient revenue stream going forward in order to adequately cover that government debt. So if we look at government debt 23, 24, and then 25, and then 26, so our gross loan debt, so I think that speaks for itself, end of government's fiscal year 24, so March 24 was 5 trillion, 5.3 trillion. 2025, in last year's budget, they estimated that at this point would be sitting at 5.5 trillion, but instead, instead we are sitting at 5.7 trillion. Okay, because this is in rand billion, so that's billions. If you want to write it all out and get a sense of how big that number actually is, it's quite enormous, to say the least. I remember once watching a presentation, and they actually had a clock ticking and basically and running and telling us every couple of minutes how many additional billion rands worth of interest we were having to pay as South Africa on this debt. And it's an alarming wake-up call. All right, so our debt is higher than we thought it would be this time last year. So we projected 5.5, it's sitting at 5.7, and we expect it to go up to 6.1 in March next year. So that's going to take us up to 76.2% of government debt. And that's kind of showing up there on that graph. But the debt service costs, if you look at it, going up from 356 billion, 382, that's what we thought it would be for this year, but it's actually going to be closer to 390 billion. So there's an extra 8 billion rand above budget, all right, on our debt service costs. And next year, we expect that to go up to 425 billion. So that's an extra 35, 36 billion rand on debt service costs for next year. I mean, just sit and think about that for a moment. 35 to 36 billion rand extra in debt service costs is what we're going to be paying next year. This is the alarming aspect of this. We often talk about the snowball effect. When you invest your money and you have the snowball effect of compounding interest, which is lovely when you're earning interest, but when you're paying interest, it also has a compounding effect, and this just gets larger and larger unless you can actually cut the debt. Because what's made it worse, of course, is also the cost of the debt for us. As our credit ratings have gone down, our cost of debt has gone up. And so, these things have all compounded to make this debt service cost enormous, to the extent that that's now taking around 22 cents out of every rand of government expenditure is going on debt service costs. It's the biggest single expenditure item in the budget. And it's making up now 5% of GDP. All right, it's going across to 5.2 and then 5.3% of GDP. To me, that is the most alarming number. The 76, yeah, alarming, not alarming, it just depends. If we were in a growing economy and we were able to manage the cost of our debt well, that we were not losing on credit ratings and so on, then it would not be so concerning. But in a stagnant economy where our credit ratings are not looking good, although it seems that we might be coming in for a better time as far as our credit ratings are concerned, believe it or not. But that's making our debt more expensive. And in a stagnant economy, I just think this is an extremely concerning situation. So once again, a reason why we have to grow this economy. If you look at how our debt service costs have gone up year by year by year since 2014 through to 2027, so over the last sort of 14 years, yeah, it just goes up and up and up every year. It's just an alarming picture. It used to be around about 100 billion rand a year. Now it's closer to 450, or it will be by 2027. 450, 4.5 times more that we're having to pay every year in debt service costs. And let's face it, our tax revenue can't go up anymore. Our government expenditure seems entrenched, and yet this is going up. How on earth are we going to balance all of this? It is very, very concerning. Well, of course, from government's point of view, they always just keep coming back to revenue. How can we get more revenue? I don't subscribe to that view. As far as I'm concerned, we have to manage expenditure and we should be focusing on economic growth. But let's just look at tax revenue for a moment and turn our attention here, because obviously this is now what we're starting to really focus on this afternoon in terms of the tax proposals in the budget speech. So if we look at the revenue composition, and again, there's a couple of different dimensions of information that I'm showing on the slide here. But if we look at what was budgeted for this year, so 24-25, what was set in 2024 budget, okay, what they thought they would get for this year, versus what we now are expecting based on what's been tabled in the budget 25, so the revised estimate. Okay, and if you just cut to the bottom line, you can see that our revised estimate, 1,846,335 million, in other words, 1.846 trillion versus 1.863 trillion. So we are down. We are expecting this year to collect almost 17 billion rand less in tax revenue than what was projected at the time of last year's budget speech. Now, where is that shortfall coming in? Well, if we look at the variance, not so much the percentages, but let's look at the rands, okay? Personal income tax coming in 6.4 billion rand less than what was budgeted. And let's just pause for a moment and remember that that is after the additional sort of tax windfall that SARS got out of that two-pot retirement system, the seed capital that people took out. I mentioned that 45 billion rand that came out of the retirement funds, and that gave rise to, they say, 11.6 billion rand in tax revenue versus what they thought they were going to get of 5. So they got an extra 6.6 billion from the seed capital, an extra 6.6 billion in tax, and yet we still came out 6.4 billion rand short. So it would have been about 13 billion rand short if it was not for that tax windfall from the seed capital. On that, we're down close to 17 billion rand, and that really is because the economy did not perform as well as was expected. And so that very much a consumption tax. Your economy doesn't perform, that comes down. But the tragedy of this is, you know, if this is coming down because the economy didn't perform, that means it's your average South African functioning in the economy that was not able to buy what, you know, was expected in terms of last year's budget speech. So the fact that we're all having to tighten our belts, spend less, etc., and some people just cannot spend because they just don't have the income, and all of that has contributed to VAT coming in at some almost 17 billion rand less than what was budgeted this time last year. Interestingly, corporate income tax and dividends tax produced slightly higher numbers, higher than what was budgeted. So that's a little bit of sunlight on the horizon. The The fuel levy, again, because of consumption. So this is literally, a tax on fuel. And I saw that the Commissioner for SARS actually issued a little bit of a press release around his views on the budget. He made mention of the fact that last year there was about 24 billion litres of fuel. This year, about 21 billion litres of fuel that was sold. So just literally less fuel. And I think if one looks at why is there so much less fuel? Now, there might be a number of reasons, but I think the one big reason is probably the fact that we had less load shedding. And so there was less diesel that was burnt trying to run generators and so on. Okay, so yeah, so that fuel levy coming down over there. Customs duty slightly lower, but specific excise duties, which is your sin taxes, that was higher than budgeted. Skills development levy came in a little bit lower than budgeted because that is linked, of course, to payroll. So it's always 1% of payroll. So if your payrolls are down, your skills development levy is going to be down. So that's also a concerning aspect. Is that indicating that what was paid out by way of salaries and wages during the year was less than what was budgeted for in 2024? Because that also is going to have very negative impact on the average South African. And then taxes on property, now that includes transfer duty, estate duty, donations tax, and that was up almost R1 billion. And then other taxes up sort of 3 billion rand. But I think overall, a very concerning picture to see that our gross tax revenue was so much less than what was budgeted for last year. If you were thinking about this in terms of a business context and you came in that much below your targeted or your projected income, I think you would be sort of taking some serious first aid steps towards, attending to your business to try and address this. And whereas, here it's just sort of put on the table, that's how it is. But it's a very concerning situation. And of course, so much of this, in fact, all of it really, links to the fact that, there was just a lack of performance as far as the economy was concerned and this kind of economic sluggardness. We're just not seeing any growth coming through, and that's impacting on our taxes. When you look at the tax revenue composition, so, I mean, as I'm sure you're all aware, that personal income tax contributes 40% of our total tax revenue, value-added tax 25%, corporate income tax 17%. So those are sort of the big three there. The next biggest one is the fuel levy, and then customs duties, sin taxes, and then all of your other taxes. I'll come back to that in a nice little pie chart later on. All right, so that's a very interesting picture as far as your tax revenue is concerned. Let me just quickly have a look and see if I have any more questions. These two have been done, so I can actually deal with that. Okay, all right. So let's move on to the next slide. So this slide here is really just taking what I looked at on the previous slide, and looking at your outcome versus budget and looking at where we fell short. So, personal income tax, sorry, it's jumping a little bit. Personal income tax down, VAT down, corporate income tax slightly up, dividends tax slightly up, fuel levy down, customs duty almost the same, sin taxes slightly up, and so on. Okay, so that's just another way of looking at those numbers. Of course, this slide over here, tax revenue versus GDP. So if we look at our tax revenue and how that's kind of increased, and you look at how our GDP has increased. I mean, I mentioned earlier that, we're not seeing the sort of increase that we need to see in our GDP, but we do see that trend coming through here. And so this overall sort of worm over here is really just saying our tax revenue. Now, earlier I spoke about gross revenue being around 27% of GDP. Our tax revenue is just short of about 25% of GDP, actual tax revenue. But that is a fairly high number. It is quite high. So people often say, are we a highly taxed country? Well, just short of 25% of GDP is a fairly high number. And I think what one always has to look at in relation to that is not just the tax revenue as a percentage of GDP, but what do you get for that? I mean, for many people, you pay the taxes and then all those services that you might expect to get from government, you've got to pay for those all over again. So, even the postal service, private healthcare, private security, the list just goes on and on. I mean, many suburbs even have to now pay to do their own road repairs and, so it's one thing to say 25% of GDP, but it's also another thing to say, what do you get for the taxes that you spend? And I think, the general feeling is that we are not getting the adequate services for the taxes that we are paying. Okay, so that little pie chart of the main sources of revenue, I took that table just now, 40% from personal income tax, 25% from VAT, 17% from company income tax, and then dividends tax, fuel levy, customs duty, sin taxes, SDL, taxes on property, and other. Okay, so yeah, that's all of your different tax revenue sources that are coming in. And then, of course, what we know as well is, and we'll focus on this a bit more later as well, is that within those areas of taxation, especially with personal income tax and company income tax, you've got a huge reliance, a skewed reliance on proportionately few taxpayers who generate most of the tax revenue. And I'll show you some more statistics on that a little bit later on. So just that point I made earlier about the two-pot retirement system, that in the 2024 budget speech, it was projected that they would get 5 billion rand tax revenue in this current fiscal year from the two-pot retirement system, rolling out the seed capital and so on. But they actually ended up collecting, they were estimating 11.6 billion. Look, we'll only know for sure once SARS does the full cashing up exercise. But this is over the period since the 1st of September up to sort of January, February, that they estimate is 11.6 billion. So that's the extra 6.6 billion rand that they collected in tax through that seed capital and the release of capital out of the retirement funds. Peter, what postal service? Exactly. So yeah, that's what postal service? Yeah, that's exactly the point. We have to pay for it ourselves. And well, let me not do any advertising. All right, let's just leave it there. Okay, so main tax features in the context of that budget context, that sort of economic context. Then we come to the budget. And as far as I'm concerned, it's just same again. You know, I mean, it's just the same. I can't even say trend because it's not really a moving situation. It just seems to be stuck, almost frozen in time in terms of what we see in the budget year by year, apart from the first item, the VAT rate increase, okay? But look at the rest of it, just no change, no change. That's what we see coming all the way across the board, just no change. So in version 1 of the 2025 budget speech, they had proposed a change to the personal tax tables, but that was then scrapped. It was kind of part of the trade-off of saying, okay, we're not going to do a 2% VAT rate increase. We're going to do 0.5%. It should be actually 50 basis points, not 0.5. I just realized my math's a bit out there, okay? It's 50 basis points, 0.5% in 2025 and another 0.5% in 2026. All right, so we know that comes 1st of May 2025, the VAT rate's going up from 15% to 15.5%. I'll talk about this in more detail just now. We're just doing the main features. No change to the personal tax brackets, rates, rebates, and medical credits, or the company tax rate. I mean, you could just go on and on. No change, just seems to be the general trend. All of this just stays the same. And what was also sad is all the monetary thresholds within estate duty, donations, tax, well, not so much transfer duty. There we do have a change, but certainly with capital gains tax, the monetary thresholds, you know, they've all just been staying the same for years and years. No change to the fuel taxes or the road accident fund levy. We do see on the transfer duty side, the actual thresholds are being increased by 10%, but the rates stay exactly the same. We see an adjustment to the wages, not just, you know, the various wage thresholds in ETI, not just the minimum wage, but the various wage thresholds are being adjusted. That's very long overdue. And it will make quite a difference to many employers. We'll talk about that in more detail. And then the sin taxes increase in many cases by more than inflation. And environmental levies, well, that's really just the carbon tax. It seems like everything else is just frozen. So, you know, all the other motor vehicle emissions tax, plastic bags tax, etc., all of that stays the same. But we do see that the carbon tax that had almost like an inbuilt annual increase that came through from the 1st of January this year. Okay, so if we have a look at the VAT rate increase, so this is what was stated in the budget speech. The first 0.5 percentage point increase will take effect from the 1st of May 2025, and the second will take effect on the 1st of April 2026. So those changes were actually specified in the budget speech. And I must just point out that in the VAT Act, and let me just call it up here, I'm going to actually read it to you. In section 7.4 of the VAT Act, it says the following. It says, if the minister makes an announcement in the national annual budget that the VAT rate specified is to be altered, that alteration will be effective from a date determined by the minister in that announcement and continues to apply for a period of 12 months from that date, subject to Parliament passing legislation giving effect to that announcement within that period of 12 months. So what that is saying is that if the minister makes an announcement, which he's done here now, saying that the VAT rate is going to increase, and he's done two at once, 2025 and 2026, what this provision in the VAT Act says is that that is law. That change happens. It comes into effect as stated in the announcement by the minister. And that will be subject to parliamentary approval, but there's this 12-month period. All right, so we're talking here about an increase on the 1st of May 2025. I mean, that's just, 5-6 weeks around the corner. Yes, there's a 12-month period for Parliament to approve, but in the meantime, that VAT rate takes effect according to this provision, unless there's a very specific agreement by Parliament to reverse the decision by the minister. In other words, to sort of undo that announcement. And it leads me on to this question around what is the process with the budget speech, because we do face the possibility of having this hung Parliament. All the political parties have said they will not support the budget speech. They will not support the VAT increase. The discussions are currently happening before the Standing Committee on Finance. They started last week and they will continue through this week. And no doubt there will be some very active discussion happening there. Within the appropriations process, there's a period of sort of 2 weeks from the date of the budget speech for the spending allocations in the budget to be approved through the parliamentary process. All right, so that's supposed to happen within that 2-week period. So it'll take us through to sort of the 26th of March. If that is not approved, bearing in mind that government's financial year, the new financial year, starts from the 1st of April, then apparently the stipulation is that appropriations being money being allocated to the government departments, right, for them to carry on functioning. So the agreement is, well, in terms of the law, the process is that those government departments could regard their appropriation as being 45% of the previous year's appropriation in the interim while they wait for this budget to be approved. So that's if the approval doesn't come through within that 2-week period, then you're down to that 45% deemed appropriation until such time as the expenditure allocations do happen. So that's that deadline on that side, but that's for the expenditure side of things. As far as the revenue side of things is concerned, as I say, in terms of the VAT Act, this percentage point takes effect on the date stipulated. If it transpires that, the other political parties vote against the decision of the finance minister to make this announcement, and it's then agreed, there will have to be an agreement by Parliament that they actually reverse this decision. Well, then they would have to reverse it. And hopefully, if they did that, they would do it before the 1st of May. But if this just keeps running, then comes the 1st of May, there will be this 0.5 percentage point increase in the VAT rate. That will happen. And, someone asked the other day, well, what if later on, they then decide, actually, no, that was a mistake. We shouldn't have done that. And let's all agree to reverse it. Well, that's going to be an absolute nightmare. I can't see that they would, well, we can't can't say never, never, because all these things happen for the first time. We are in uncharted territory at this stage. So, anything's possible. But we would hope we don't have a situation where the VAT rate seemingly is triggered on the 1st of May because of the legislative provision, and then later on it's reversed. But I think what we are going to see is that the VAT rate increase will be triggered on the 1st of May. Well, yeah, it is subject to that 12-month parliamentary approval. I'll come back to the sort of ins and outs of that. You'll see I put some links at the bottom of the slide, and I've added these in. So what I'm going to do is send through these links to Danny, and he can just pass it on to you. Or perhaps what I'll do is during the break, I'll just copy it and pop it into the chat so that you can each pick up these links. But it's nothing magical. It's just on the SARS website, as you can see there. If you just go onto the SARS website and just go onto what's new, and you'll see there that they've put these directives around what's going to happen with the VAT rate increase. Okay. Anyway, let me carry on with what's on the bullet points here. So in the budget documentation, government stated the following. They said, in making this decision, government carefully considered the potential contributions of each of the main tax instruments. VAT is an efficient source of revenue. It is broad-based, and its design is simple with minimal exceptions. And so that's the explanation for choosing the VAT rate to provide them with additional revenue. Now, in terms of their Chapter 4 projections, they expect to get an extra 13 billion rand in tax revenue as a result of this VAT rate increase. So an extra 13 billion through the VAT rate increase. That is going to be offset to the tune of about 2 billion rand by supposedly extending the list of zero-rated items. So the net effect on the VAT amendments is an additional 11 billion rand. Now, in the first version of the budget speech, that didn't happen, but in the documentation that was there, they were projecting to get an extra 60 billion rand in revenue through a 2% hike in the VAT rate. Now they're looking at an extra 13 billion through this 0.5 percentage point hike. And then, of course, next year, another sort of similar amount through the additional 0.5 percentage point hike. It remains to be seen whether that actually happens, depending on the parliamentary approval. All right. They went on to say increasing taxes on consumption through a higher VAT rate will have the least detrimental effect on economic growth and employment over the medium term, relative to increases in personal or corporate income tax rates. Well, that remains to be seen. We all know that VAT, if you increase the VAT rate, it has a detrimental effect on the economy. And really, we've got so little going on in terms of the economy anyway, that there's no doubt that this would have a detrimental effect. So I'm not sure that that really makes a whole lot of sense in terms of that statement. But if we have a look at these links here, so SARS has now just recently, as I say, it's still on the What's New section on their website. They've put up this document called Frequently Asked Questions, Increase in the VAT Rate from 1 May, and then a pocket guide on the VAT rate increase from 1 May. And what we can do is towards the end of the webinar, I can just call these up if you want, and we can just go through them. But if time runs out, then please just have a look at this, because it does walk you through how that VAT rate increase is going to work. But if you think back to 2018, okay, I know that was a while ago, but we had the last VAT rate increase in 2018. Now, the key thing is that when the VAT rate increases, it increases from the 1st of May 2025. So to state the obvious, the VAT rate goes from 15% to 15.5%. Now, that 15.5% rate will then apply to any supplies made on or after 1 May 2025, pretty much. That's the essence of it. And to say, well, how do I know what supplies were made? You have to come back to your time of supply rules in Section 9 of the VAT Act. And there you have your very specific time of supply rules that come through. And you have a sort of a general time of supply rule, and then you have some specific time of supply rules. Now, if I look at your general time of supply rule in general, a supply happens, the time of supply is the earlier of when an invoice is issued or any payment is made towards the consideration for the supply. All right, so you issue an invoice on the 1st of May 2025 in the ordinary course of events. That must then carry VAT at 15.5%. You issue an invoice on the 30th of April, it would have VAT at 15%. That's the kind of general rule. But of course, there are always specific situations that come into play. And what you also have to bear in mind is that you do have specific rules in the VAT Act, Section 67 and Section 67A, that are there specifically to guide us and provide some anti-avoidance rules around when there is a change in the VAT rate. So it tries to avoid people trying to kind of rush things through, you know, pay this amount before the 1st of May and you can get it at the old VAT rate. Well, there are these anti-avoidance rules that kind of override that in some circumstances. So just be careful about that. And then there's also, with the time of supply rule, they talk about successive supplies, like insurance contracts, if you're paying, or rental contracts, where you're paying a same amount month by month by month by month. Well, in that eventuality, your cover, your insurance cover or your rental for May will then be at the higher rate of 15.5. So even though the contract that you might have signed at the beginning of the year specifies 15%, but by law, that rate goes up to 15.5. That's just how it is, as those successive supplies take place, unless the contract specifically prohibits any change as a result of the VAT rate. But then what would happen is that the supplier is going to basically absorb that increase in the VAT rate. So there's all these different rules that come into play. And SARS also has put out this pocket guide on the VAT rate, and I'll see if I can get it onto the slide. Hopefully you are still seeing my screen here. But this little pocket guide here, just see if I can make it a bit bigger. Yeah, so here you'll see that SARS on this document has given all these different rules around the time of supply, the agreements, what happens in the case of different types of supplies, bearing in mind any documentation, any quotes, any invoices, advertised prices, etc., from the 1st of May 2025 have to show VAT at 15.5%. Importation of goods from that date on will carry VAT at 15.5. Obviously, your accounting systems are going to have to deal with this. And another question that came up, and this was a bit of a mess in 2018, but SARS has indicated here that the VAT 201 return will be updated to reflect the new VAT rate in time for the VAT reporting periods. And that if you do have a tax period, let's say a 2-month tax period, April and May, where you've got some supplies in April at 15%, supplies in May at 15.5%, you would have to disclose that separately on the VAT 201 return. Last year, or last time around in 2018, SARS had to come up with a bit of a workaround there, and they had to sort of issue a special notice to all the vendors as to how that was going to work. Well, we'll have to see what happens this year, if they're actually going to amend the VAT 201 return to reflect the 2 different rates, or they will just tell you to disclose this in 2 different line items on the VAT return. But you have to show your 15% and your 15.5% supplies separately if you've got a tax period that has both of those periods. Okay. And then they've got these VAT specific rules that come through, and then they talk about rental agreements, successive supplies, and so on. Okay. And then another important one is, if you go across the right-hand side here, supply of residential fixed property. Notice here, even if the time of supply is triggered after 1 May, because the time of supply for residential fixed property is the earlier of registration or payment of the consideration, okay? So if that time of supply is triggered after 1 May 25, due to payment or registration taking place after that date, but the supply could still be subject to VAT at 15% if, okay, so you still get the lower rate if the contract was concluded before the 1st of May, both the payment of the purchase price and the registration takes place on or after 1 May, and the VAT inclusive purchase price was determined and stated as such in the agreement. Okay, so there is that situation that's a little bit different to our normal rules that apply, and that it applies to residential fixed property. Okay, so this document from SARS issued 13th of March, very, very important. Please do make sure that you get hold of that. Well, I've given it to you on the slide, which I've now managed to lose. So let me see if I can pull that up again. There we go. Okay, so yeah, so both of these, the frequently asked questions and the pocket guide on the VAT rate increase on the SARS website, and hopefully this frequently asked questions, they'll keep updating that as they go along with more questions. But I think they can kind of preempt most of the questions because of having gone through this process in 2018. Now, one of the big motivators for increasing the VAT rate was that SARS said that our VAT rate is low compared to other countries, and they pulled out this from the OECD, and they looked at VAT rates. The OECD countries, there's 36 countries. We are not a member of the OECD. We have observer status. So we slotted in here, but we're not an OECD country. Okay. Some of these others also not OECD countries. It's just that OECD has pulled out these numbers, and we see the OECD average. But OECD is mainly your sort of first world developed countries, US, the European countries and so on are generally the members of the OECD. So the fact to say that our VAT rate is lower and therefore there's scope to put it up, but you can't just look at the VAT rate in isolation, right? You've got to look at the overall tax policy. And what is our mix of taxes? You know, we've got a tax policy that looks at our mix between direct and indirect taxes. And clearly, our policy is that we derive most of our taxes through direct taxes. And that's why we see, 40% of our tax collections coming from personal income tax, 17% from company income tax, all direct taxes. 25% comes from VAT, which is an indirect tax. So we have in our tax design, we have decided that indirect taxes will be a lesser component of our overall tax collection. So you can't just suddenly say, well, let's hike the VAT rate because everyone else's VAT rate is higher than ours, because what is their actual tax design? What is their tax policy? You've got to look at that all together. And certainly when you look at these other African countries, a key feature of the tax systems across Africa is that they tend to be deriving more of their tax revenue from indirect taxes. So you would expect their VAT rates to be higher than ours. Or another interesting one that was quoted in the budget speech, the VAT paid per expenditure decile. Now, we always hear the story that VAT is unequal in that an increase in the VAT rate impacts more harshly on the poor than on the rich. And that really links to the fact that if you look at a low-income household, they probably spend a greater percentage of their income is spent on consumption items, right? Compared to a high-income household that will typically have investments, savings, and so on. And so if you said what percentage of a person's income is spent on consumables, high income versus low income would have a higher percentage. And that's why when you increase the VAT rate, it's going to impact in that sense more harshly on the poor. But it's interesting to see that where VAT comes from, obviously VAT paid per expenditure decile, the majority comes from your upper households. Because yes, your expenditure is much higher in your upper households, and therefore there is more VAT that is paid. Now, the other aspect with our VAT system, and this is to counteract VAT being unequal and affecting low income households more harshly than high income households proportionately, is, of course, that is offset to some extent by our list of zero rated items. And in the budget speech, it was stated that the VAT system currently zero rates 21 essential food items in an effort to make them more affordable for lower income households. Government proposes to extend the list to mitigate the effect of the VAT rate increase. I mean, it's interesting, this list of essential food items, it's quite controversial. And if you think about it, most of those items on the list have been on the list ever since VAT was introduced in 1991. Okay, that's like almost 35 years ago. And I'm not sure that a real comprehensive study over a prolonged period of time has ever been done to really conclude that that list of zero-rated items is appropriate for your low-income households. Because obviously anybody who buys a food item on that list is going to benefit. So raw fruit and vegetables, okay, you go and buy your raw fruit and vegetables at Woolworths, you would also get that zero rating. So it's not as if it's only the low-income households who benefit. And that's why they supposedly try and make sure that the types of foods that are on that list would be the types of foods that your low-income households will typically buy. But inevitably, that logic sort of goes out of the window. Even in terms of this expanded list now, they've just recently published the draft Revenue Laws Amendment Bill and Taxation Laws Amendment Bill, which contains this expanded food item. And where it talks here about canned vegetables. So they're saying here they're going to extend it to include offal of sheep, poultry, goat, swine, and bovine animals, specific cuts such as heads, feet, bones, and tongues, dairy liquid blends, and tinned or canned vegetables. So that's supposedly what they're going to extend this list to include. Now, what's actually come through with the tinned and canned vegetables is that it's only beans and peas, all right? Tinned beans and tinned peas. And yet soup mix, the sort of dried beans, peas, and lentils is not on that list of zero-rated items. So it's very controversial as to how appropriate this list really is for your low-income households. And that's the problem. You see, as soon as you start trying to introduce some kind of interference in the system, there's going to be unintended consequences that come out as well. So this zero-rated list is by no means a perfect list, but at least they put the word out there that they've tried to expand it, and they're giving something back to offset the increase in the VAT rate. And as I say, the increase in the VAT rate they're expecting this year, over this next year, sorry, the 25-26 year, with a 0.5 percentage point increase is going to produce an extra 13 billion rand of VAT, and that will be offset by 2 billion rand because of the additional zero-rated items. Okay. And they say this decision considered the risk of tax base erosion and the distributional impact of the items identified. Zero rating is a blunt tool, and that's the point I was making. It is a blunt tool. It's an interference which is going to, not achieve a perfect outcome. It's a blunt tool to assist lower income households because there's no guarantee that there will be a reduction in prices. And that's the other concern here. As you can say, all right, we're going to add tin beans and peas onto this list, but will the retailers actually change their prices to reflect the fact that this is now zero rated? Time will tell. They say zero rating that is not well targeted results in a large portion of the revenue foregone benefiting higher income households. And nonetheless, the survey shows high consumption of the proposed additional items in the lowest 4 expenditure deciles. And that's that 2 billion rand that they are going to forego in government revenue to see through this list of essential food items. So yeah, if you want to see the food items, you can have a look at the draft bills that have recently been released, and you'll see the list of different items on there. And yeah, there's quite a bit being written about it in the media currently because, as much as you try and say, well, we're going to have these cuts of meat that are typically consumed more by low-income households, but then you get people who are maybe from high income households also consume that, and they're going to benefit from the zero rating. Well, it is a blunt instrument. It's never going to have a perfect result. Okay, so I think moving on from the whole issue around the VAT, let's go on to the tax tables for individuals. And as you know, and as I mentioned at the beginning, although in the first version of the 2025 budget speech, there was an indication that they were going to do some inflationary adjustments to the tables, but as we sit now, that's now been taken off the table, and we sit again with a third year of tax tables remaining unchanged. So these were unchanged from the 1st of March 23 through until the end of Feb 24, that was year 1, and then again February 25, year 2, and now again February 26, year 3. All right, so 3 years of tables being completely unchanged. Okay, the first year was a little bit of an uptick from the previous year, but since then, it's remained completely unchanged. Now, as I showed you earlier with CPI and inflation, households are facing inflation. And I mean, the CPI is sitting just short of 5% per year. And actual household inflation, if you look at the cost of clothing, you look at the cost of schools, you look at the cost of bond interest rates, and so it just goes on and on. Never mind the cost of medical cover and medical expenditure, which is medical inflation is always higher than your general inflation rate. And so individuals generally would have to see an increase in their income since 1 March 23. Income would have had to have increased in order for people to maintain their standard of living. But what this is telling us is that any increase in your income could very well take you into the next tax bracket. So if you were sitting at sort of, 380,000 Rand, and so you were in this, sorry, that's a bad example. If you're sitting at 350,000 Rand and then you had increases and then another increase, it might well be the situation where you are now going above the 370,000, and that's taking you into this next tax bracket. So you now are in a 31% marginal tax rate, whereas previously you were only in the 26% marginal tax rate category. And I mean, that's quite a big jump, 26 to 31, 5%, another 5% up to 36. Then it actually slows down a bit, 3%, 2%, 4%. But this is a very concerning situation. When you look at the projections in the budget speech, the bracket creep. So people's earnings increasing, even if just in line with inflation, or maybe not even in line with inflation. But if they did increase in line with inflation, that would have this bracket creep scenario. And in the budget speech, they anticipate that will give them an extra 18 billion Rand of taxes. So by just sitting back and doing nothing and letting inflation do the work, and of course all the workers doing the work, they would get an extra 18 billion Rand of tax revenue. That is enormous. I mean, if you think about it, the increase in the VAT rate offset by the zero-rated items, I said, is going to generate an extra 11 billion. This is way overtaken, an extra 18 billion Rand coming through bracket creep on the individual tax table. Now, if you look at the SARS statistics, there's around about just short of 26 million individuals. Oh, sorry, this keeps jumping. I think I must maybe just take my finger off the mouse. 26 million individuals registered as taxpayers. But of course, not all of them submit returns because the majority of those people are earning below the tax threshold. And so they're not actually required to submit returns. So there's about 7.5 million people who are currently in the last tax year required to submit tax returns. And about 6 million of those actually pay tax. I'll come back to some more statistics on that after the break. But so if you're looking at that, 40% of tax revenue comes from individuals, personal income tax, and then it actually comes down to 6 million people. Actually, it comes down to far fewer than that are actually contributing the bulk of that 40% of tax revenue collection. And here you see this huge additional reliance on individuals, looking at this extra 18 billion Rand in tax revenue coming just as a result of inflation. So our rebates and tax thresholds, again, remain unchanged. So if you think about it, if somebody was earning, 90,000 Rand in 2023, and they had a 6% increase to their salary and another 6% and another 6%, that's going to now push them over that 95,750 threshold. And that means that whereas before they were not paying tax, now they are paying tax because inflation has pushed them over the threshold. So it really is a very unsatisfactory situation, and especially harsh on your lower and middle income earners who are getting pushed into these higher tax brackets. So the same rebates, same thresholds apply as applied previously. Now, just an interesting one. If you look at the contribution to tax revenue, oh, let me just pause here. I see that there is a question. I can get to that. Shirley says 18 billion Rand extra with 6 million taxpayers on average, 3,000 per person. Yeah, very rough average. It could be. And I mean, that's horrendous. That's straight out of people's pockets into government. So it's taking out of the pockets of consumers and putting that money into the hands of government. Now that tax revenue, all right, just going all the way back, let me just do it like this. If I go right back to one of my earlier slides where I was showing tax revenue composition, okay, and I was showing personal income tax for this current year projected to generate about 732 billion rand, okay? Now, if we go through to where I was, so that contribution is coming, obviously, we've got these 6 million people, well, 7.5 million, let's say, submitting tax returns, but there's about 500,000 of those that are below the tax threshold. All right, so it's coming into the 6 billion rand category in terms of the people who are actually contributing tax revenue. 3.8 million taxpayers are contributing about 11% of the total tax assessed. This was according to the SARS statistics for 2024, but they were looking at their 2023 assessments. At that stage, just over 80% of people had been assessed for 2023. Okay, and they're saying for that year, 3.8 million taxpayers produced 11% of your tax revenue. 2 million taxpayers earning between, well, so just to finish off that picture, that 3.8 million were taxpayers earning up to 350,000. And that's why there's more that were earning below the actual threshold of 95,750, okay, because that's going from 20 up to 350,000. But 11% of your total tax revenue coming from those taxpayers. People earning between 350 and 1 million, so kind of your middle, slightly higher income earners, there's about 2 million of them, and they produced 44% of the tax revenue came from that group. And then people earning 1 million rand and above, they had 342,000, and they produced 45% of the tax revenue. So 45% of the tax revenue. Now, I said earlier that of that 732 billion rand, right, about that comprises 40% of our total tax revenue. And of that, 45% is coming from 341,000 taxpayers. I mean, that is a huge reliance on a very small number of taxpayers. Let's not discount this group over here. There's 2 million that's producing about almost the other half of taxes. And then we've got the majority of taxpayers are producing within this 11% category over here. So all I'm showing you here is how skewed our tax collection is in terms of focusing on a very small tax base. And this is something we can never forget when we talk about, people say, well, why don't you increase the tax rates and so on? The thing is, we've got such a small tax base, and this small tax base is so heavily taxed and so over demanded upon in terms of having to pay for all of their own services and their own private everything, in addition to paying significant taxes, that you cannot expect to take any more taxes out of this group. It's just not possible. You could try, you can raise the tax rate, but the reality is you're not going to get any more taxes out of that group. And Peter, interesting, the age distribution, I did have a look at that on the SARS statistics. And it is interesting that, we do have a fairly aging population within that 341,000 people. I can't remember the exact numbers, but certainly they are within a big percentage of them are kind of slightly older taxpayers. And that's also concerning because obviously we would hope that the younger taxpayers earning the lesser income would come through and the income would grow and they would be able to produce additional tax revenue. But just, I think a big concern is, and it's a concern that's on all of our minds, and that is, the number of taxpayers who've left South Africa. I remember once, in fact, it was when I was doing the research for my PhD and it was on wealth taxes, and I was interviewing a very well-known financial advisor in South Africa. And he made the point that South Africa's best exports over the last number of years, the last couple of decades, our biggest export has been our taxpayers. And if you think about it, how many taxpayers have left the country? And it's not just them, it's their subsequent generations as well. So we're very good at exporting taxpayers. And as a result, we end up with this situation where we've got 28 million people on social welfare, 6 million possible taxpayers, but then a huge reliance on just a very small number of taxpayers. What does the percentage number indicate in the orange graph? So that number in the orange graph here, whoopsie, let me just go back there. Sorry, I just want to get rid of this so that I can always do this. I get myself into a bit of a, let me just see if there's another question while I'm at it. Okay, so that answer in the orange graph, sorry, now I need to just get back to my slide. Yeah, in the orange, if you look down here, that is taxable income. Okay, so that's your actual taxable income. So, yeah, taxable income, I mean, it's interesting, but what we're really looking at is the taxes that have been collected. All right, thanks for that, George, because I probably did jump over that a little bit too quickly. All right, so yeah, a very interesting picture. And of course, the concern is, you know, if we keep losing high income earners overseas, so we keep losing more of our taxpayers, where is that going to leave us, especially considering the increasing number of people who are relying on government grants, etc. I just came back to that one, but I've answered that. Okay. So another interesting aspect that came out of the SARS statistics looking at personal income tax is also what type of income do people earn? And so we would expect, you know, if you look at this big red slice down here, that's your sort of salaries, wages, remuneration. And so that makes up 40% of our total taxable income that comes through the personal income tax system. 40% from sort of regular salaries and wages, but then another 29% through annual payments. So it's basically 70% that comes through remuneration in the form of salaries and bonuses. Then you get your director's income and you get your commission. Sorry, that sort of floated off into the nether regions there, but commission is 2.6%. Then you've got local interest, and that's quite interesting. Local interest. So that is, bearing in mind, this is taxable income. So this is interest from a South African source that is taxable. So it's after taking off that local interest exemption. Okay, so local interest coming in there. And then overtime, which of course is another form of remuneration. Pension income, that's going through to your pensioners by way of pension annuities, and then all other sources of income. And now if we're talking personal income tax, all other sources of income would include the income of sole traders, taxable income of sole traders, and so on. Okay, but it is your, obviously there's dividends, local dividends don't feature in here because those are pretty much all exempt. Okay, so they would be going into, if any aspect of it was taxable, because yes, we do have certain situations where local dividends do become taxable. We've got foreign dividends that are partly taxable. That would all come through into other sources of income, as would foreign interest also come in here. Okay, but here we've got local interest, which is sizable enough to have its own little slice of the pie. And I think that's interesting in terms of types of taxable income, because it shows also the huge reliance on payrolls to generate tax collections, because pretty much all of this is coming through payroll, other than your local interest, maybe your director's income, although even some of that will be coming through payroll, but that could be mainly your non-executive directors, local interest, and you know, even pension income comes through the payroll. So payroll is a huge aspect of our tax system in South Africa, and of course, yeah, is responsible for collecting the bulk of our personal income taxes, which contributes 40% of our total tax revenue in South Africa. And then just quickly before we stop for a short break, so our medical scheme credits, 6A credits, this is your fixed monthly credit, again, unchanged. This amount has been frozen also since 1 March 2023. Now, separately, to the result of freezing the actual tax tables and rebates, you know, the primary, secondary, tertiary rebate, the freezing of this credit will generate an additional 1.5 billion rand over the next tax year. So we had 18 billion coming through the freezing of the main tax tables and rebates, and an extra 1.5. So that's almost 20 billion, 19.5 billion rand being taken out of the hands of individuals, put into the hands of government through these measures. So let's not think that there's no tax increases coming through this year. We got big tax increases. It's just that it's all coming through in this way of stealth taxes, allowing inflation to do the work. And I think, you know, if you think about members of medical aids, and I mentioned earlier about medical inflation generally way higher than your general inflation rate. So general inflation rate might be sitting just shy of 5%. Medical inflation is probably sitting 8 to 10%. Just have a look, think about what your medical aid contributions have increased by last year compared to this year. And then, of course, what do you pay when you go and see specialists and for blood tests and all those kinds of things? And your medication, you know, that's all going to be way more than a 5% increase over last year. Just this medical credit alone, of course, that is very much focused on your medical aid contributions. Anyone who is contributing to a medical aid scheme gets this credit. But your contributions will have gone up by, you know, probably 10% each year, and yet this credit has stayed fixed. And so, yeah, an extra 1.5 billion rand of tax revenue coming through from that. George says, what about out-of-pocket medical expenses? Yeah, well, out-of-pocket medical expenses over and above medical schemes. And I think that is becoming a bigger and bigger feature because medical schemes seem to cover less and less. And of course, the cost of that, even if you look at just basic things, Panado, Arendse, whatever, you know, surely the high earner who leaves the country also takes their skills, ultimately affecting the source of taxes. So very good point, you know, and that's just another spin-off of our exporting of taxpayers. Now, it does take us to 3:30, so I think I'm going to stop there. I've got a little bit more to say about medical credits, but we'll hold that for after the break. Let's take a 15-minute break, and I'll see you back at 15:46. See you just now. Okay, right. Welcome back, everybody. I hope you had a good stretch and a good cup of tea or coffee. And let's then carry on for the second part of the webinar. I said I'll carry on talking about medical credits. So what I wanted to point out here, and as I mentioned with the SARS statistics that they published for 2024, they were basing this on 2023 assessments. At that stage, they'd assessed just short of 90% of taxpayers for 2023. And they then, of course, analyze, who pays how much tax and who's claiming what deductions and so on. So the Section 6A medical credits, they put out this little table here, which is quite interesting, that if you look at the number of taxpayers, I mentioned around about 6 million taxpayers paying tax, okay? So there's about 3 million taxpayers who claimed the 6A medical credits in that year. And of those taxpayers, they then analyzed them by taxable income group. So 0 to 100,000, that's most of those are under the 95,750 threshold. There's about 1% of taxpayers there. So yes, you've got a small number who are claiming the medical credits, but then many of them would probably be under the threshold in any event. Then we've got the 100,000 to 350,000, the 350 to $1 million, the $1 million to 5 million, and the over 5 million. Now, if you look at how much credit is claimed by each of these groups, what I want to focus on is the average per taxpayer. So if you look at your 100 to 350,000, on average, the taxpayers they're claiming 7,442. Now, if you think about it with the medical credit, so if you go to a member, first dependent, each additional dependent, so I think if you had a member, one dependent, two children kind of scenario, you're looking at sort of 1,200 per month. So that'd be significantly more than the 7,442 that's been claimed over there. So just to kind of give you a sense of the kind of credits that people are claiming, it's not a huge amount. That's indicating that on average, that's probably a member and one dependent, and maybe a child here and there. And if you look at taxpayers up to the R1,000,000 category, it's up a little bit more. But then remember, there's more taxable income against which the people are setting off their credits, because you can only set these credits off to the amount of actual tax liability, tax per the tables, minus your primary rebate, secondary, tertiary, and then minus your 6A credit. But you can only set off as much as you can to reduce your tax liability down to zero. All right, so that's then the amount that's claimed there per taxpayer. Taxpayers earning over $1 million, let's just lump those two lines together. So there's around 9% of taxpayers. There's your 280,000 people are claiming. Out of, I showed you on this table here, the number of people earning above $1 million was 342,000. And here we're saying about 280,000 of them claim the medical credit. Okay. And their average credit is kind of around 11,000 Rand per person. Now, what is interesting from this is that there has been the criticism leveled around NHI coming in, that medical credits should be scrapped. And the one argument is that it's unfair because it's mainly your higher income earners who are benefiting from the medical credits. Now, this indicates that your average credit claimed per taxpayer is more in the higher income brackets. But yeah, that probably means that those are people who belong to more of them belong to medical aids, etc. And that's why they are claiming more medical credits. Can it be that they have bigger families, perhaps? So there's various things that might come into it, and that their tax liability is that much higher, and then that there's a greater amount of credit that would be claimed on average. All right, but it's not significantly distorted, I don't think. If you look at your 100 to 350 or 350 to $1 million, and then you're above R1 million, there's not a significant distortion on how much on average is claimed per taxpayer. But just some interesting numbers to throw around there. And then if we look at this table here, so your 6A credits per taxpayer group, so your taxpayers earning above 5 million are getting about 11% of the credits, but remember they contribute 45% of the taxes. And then your 100 to 350,000, they're contributing 45% of the credits. And then your 350 to $1 million is getting 44%. So it's just the split on your tax credits per taxable income group. Okay, so before I go on to the interest, I saw that there was a question that popped up there. So let's have a look at that question. Peter, again, could be an age thing, yeah. And this, so look, this 6A credit is just, we're not looking at the additional credit there. We're looking at, the credit for people who belong to medical schemes, who are contributing to medical schemes. The secondary rebate doesn't feature here. I haven't put it in, although SARS does have a separate table on that. I just didn't want us to drown in statistics, but this is just the 6A credit, not the additional one. Okay, so that's the medical credit situation. And I guess what is also interesting, just to jump back 2 slides, or one slide, is how much is given up every year. If you look at the tax take, how much is given up by way of medical credits? It's about 25 billion rand. So if we just did away with the medical credits, hypothetically, we would be able to get an extra 25 billion rand in tax revenue. Okay, that is just a hypothetical, kind of a very blunt calculation. But I'm not for a moment suggesting that we should do away with this and get that extra 25 billion, because I think there are other areas where one could look if you are looking at generating additional revenue. Okay. Interest exemptions. Let's look at interest exemptions. Now, I showed earlier how much interest is derived if you look at the total amount of income that is earned by taxpayers, and there was that one little slice that came from interest. Of course, there's a lot more interest that comes through. Let me just get back to that. So we're saying about 2.8%, 351 billion rand in interest, but this is taxable income. So there's probably a lot more than that is earned, but most people, I would venture to say, would end up with zero taxable income from interest because of these interest exemptions. Now, this is a local interest exemption. It only applies to South African source interest. It hasn't been changed since 2013. Not a surprise, because that was when your tax-free savings accounts were introduced. And at the time, the then Minister of Finance announced that there'd be no further changes to the interest exemption, that this would stay fixed and the tax-free savings accounts would kind of take over in terms of the tax policy instrument to encourage household saving. So we've seen these amounts stay the same since 2013, under 65, over 65. Remember that if a person has a year of assessment less than 12 months, you have to apportion these amounts. Now, even non-residents may look at this exemption in some circumstances. If they get South African source interest, non-residents are taxed on SA source income. So potentially they'd be taxed on that interest. There is a non-residence interest exemption, which gives a full exemption on interest paid to non-residents. But in order to qualify for that full exemption, they would have to be physically absent for at least 182 days during the 12-month period before the interest accrues, and the debt must not be effectively connected to a fixed place of business in South Africa of that non-resident. So if you have somebody living outside South Africa, they don't spend too much time here, they earn SA source interest, they would get this full exemption. It's possible that they would be subject to the interest withholding tax of 15%. But of course, there's a lot of exemptions. So interest paid by banks and so on is exempt from the interest withholding tax. But some interest going through to non-residents would be subject to the interest withholding tax. Okay, so the exemptions on interest, no changes there. Our tax-free investments, and I think this is quite unfortunate, we start getting back to all the things that have not changed. And our tax-free investments annual threshold of 36,000 unchanged since 1 March 2020. I mean, really, why not just increase that? This has got an excellent tax policy motivation in terms of encouraging people to save, getting into the habit of saving, even small amounts per year. That's the motivation here. Even if you just save 36,000 per year, put that away, let it accumulate totally free of tax. And over a long period of time, talking about that snowball effect of incremental interest, you would end up with quite a nice investment. It's really a very useful tool to use in one's overall investment portfolio. You know, people always look at this and say, oh, but 36,000 is so small. But if you had been saving this ever since tax-free investments were introduced, and they've been with us now for more than 10 years, you would have a good amount of capital invested plus investment return tax-free. You'd probably have well over R500,000 sitting in that account. So it all accumulates. But to get back to my point, the threshold has not increased. So you can still only invest 36,000 per person for this year, and the lifetime limit is 500,000. The lifetime limit for what is contributed into the investment, not the balance on the investment, but what you've contributed into that investment, cannot exceed 500,000 over a person's lifetime. And then other things that have not changed: the company tax rate, dividends tax, all exactly the same. So we have the same effective tax rate. Of course, last year, we saw the announcement around the global minimum tax being introduced. That came in through last year's legislative cycle. It's a tax rate of 15% is the minimum tax. And so companies within a multinational group of companies, the companies that interface into South Africa, would have to look at their effective tax rate, and if it's less than 15%, they would have to do this top-up calculation. Now, at the time of the announcement around the global minimum tax last year in the 2024 budget speech, they projected that in the 26 year, they would get an extra 8 billion rand in tax revenue, and that is something that should carry on year and year beyond that. The reason why only in 2026 is because the companies that are subject to the global minimum tax, the first year end that would be affected would be 31 December 2024, all right, because the tax came in from 1 January 24. So first year of assessment, end of December 24, and those companies have 18 months to do their submissions and calculations, etc. And only then would they have to pay the top-up tax. So it takes you through to June 2026. And that's why we would only see the additional tax revenue in that year. But the expectation of an extra 8 billion per year, well, it remains to be seen how that materializes. Now, just looking at company tax rates, obviously there's always a lot of discussion. Should we put up the company tax rates? Should we be dropping the company tax rate? We saw the tax rate come down from 28 to 27% a few years ago now. But if we look at, again, looking at the OECD, because they just have a lot of data on taxes, we see here, now these are all the OECD countries, Australia, Chile, etc., etc., etc. Notice even Colombia is a member of the OECD. South Africa is not. So our South African tax rate is sitting here at sort of 27%, if you had to just draw an imaginary line across there. And you'll see that many tax rates are well below that. But again, you can't just take the company tax rate and say, oh, ours is too high, we should drop it, because you've got to look at it in terms of the overall tax design, our whole tax policy design. What is interesting is that the OECD did make the point that statutory corporate tax rates across 143 countries have remained stable over the last 5 years, from 2019 to 24. We haven't seen huge changes. In fact, the average has come down slightly from 21.7 in 2019 to 21.1 in 2024. So our company tax rate at 27, yeah, look, I mean, we certainly can't afford to drop it, because we've got to hold on to whatever tax revenue is there. But there doesn't seem to be much argument to increase it either, because the rate is fairly high if one compares across the world. Now, I just want to have a look a little bit, getting back to the SARS statistics, at the company tax situation. So if we look at the company tax collections, and again, maybe I should just quickly jump back to this earlier slide where we looked at our total tax revenue. Okay, over here. Just bear with me for a moment. Over here, all right? So we are saying that in this current fiscal year, we're expecting corporate income tax to produce 316 billion rand, which is going to be about 14 billion rand more than what we originally anticipated at the time of the 2024 budget speech. Now, just holding on to that number, 316 billion rand, if we now have a look at the companies on SARS books, as it were, they've got a total of 1.17 million companies registered as taxpayers, okay? 1166692. But when we analyze the number of companies on SARS register, we see that actually a lot of those companies have a loss, and in fact, significant loss. So we've got almost 300,000 companies with an assessed loss sitting at about 1.8 trillion rand in aggregate at the moment. All right. Somehow they've still got some tax assessed out of that lot, but be that as it may, that would be probably from the ring fencing of the assessed losses. But the companies are still sitting with losses having been reported. This is for 2022. It's the latest numbers that SARS had when they put together their 2024 statistics. But then you've got about 600,000 companies with zero taxable income, so they're tax exempt, so they pay no tax. Then that leaves you, so that's basically 900,000 out of the 1.2 million. So it leaves you with, like 200 odd thousand companies that actually pay tax. So again, if you look at our tax base being skewed, we look at this when we saw the personal income tax, and we saw that 45% of that 40% of tax revenue coming from personal income tax, comes down to those 300,000 taxpayers. Here we've got like 240 odd thousand taxpayers that are producing basically all of the tax assessed, and that was 328 billion for 2022. So again, very skewed. And if you look at your high income companies, so earning taxable income above 100 million, 27.5, almost a third of our total company tax collections come from that group. Okay, so it's split, sort of 20%, 28% between these different taxpayers. Sorry, that's the average tax rate. Sorry, I'm focusing on something else. But your actual tax assessed, sorry, this is what I wanted to focus on. I'm losing myself. The actual tax assessed, 237 million out of 328 million comes from these companies with very high taxable income. So think about that in terms of a skewed profile of taxpayers and the reliance on just 1,000 companies. We're relying kind of 90% of our tax collections coming from 1,000 companies. I mean, that's incredibly skewed. And when you look at the average tax rate, bear in mind for 2022, the company tax rate was 28%. So they're all falling a little short of that. But up to the million, you're probably talking about a lot of small business corporations there that have a lower average tax rate. And here the tax rate is very close to 28%. The other thing I wanted to illustrate here from the SARS statistics, and they gave us a very nice little slide here that I've just copied and pasted. And this shows the company tax assessed per economic sector. So of that company tax assessed, all right, this column over here, and we did it by size of company here. Now we look at economic sector. So 32.8% coming from the financial sector, about quarter coming from mining and quarrying, 13% from wholesale and retail, catering and accommodation, 1/6 coming from manufacturing, 5% from transport, etc. And so we go down to these little bits here, all other sectors, and this is community, social, and personal services. So the financial sector, certainly the very big one. Mining, I think there was a little bit of a commodities boom in 2022, so that boosted the mining quite considerably in terms of their tax revenue. But financial sector, we saw this even earlier in terms of our economic growth, really coming through the financial sector there. So we are quite reliant on the financial sector, and certainly very reliant on just a small number of very large companies. Sorry, I got a bit of a tickle in my throat. Just coming back to that assessed loss situation, all right? I showed you over here, because I find this quite alarming, the magnitude of assessed losses. So we saw here that almost 300,000 taxpayers had losses, an assessed loss situation, and that accumulated to about 1.8 trillion rand. Okay, so many of those companies are never in the foreseeable future going to be in a tax-paying situation. If we look at the spread of assessed losses, the value of assessed losses for companies 2016 to 2022. And we see here sort of assessed losses above 10 million. And we see how many of these companies and the magnitude, how these assessed losses are just growing and growing, especially the very, very large assessed losses above 10 million. Even the smaller assessed losses per taxpayer seems to be getting bigger and bigger and bigger. I did miss the slide here, the distribution of company income tax by sector and taxable income group, looking at agriculture, mining, etc., etc. And here we see the total taxable income being less than zero, equal to exactly zero, and greater than zero. So all the orange that you see here is the number or the percentage of taxpayers within that sector that have losses, okay, taxable income less than zero. And so you can see the big ones that have the losses: electricity, gas, and water, the retail, and transport, storage, and communication. Okay, even the financial sector, massive percentage of companies with losses. Okay, but then of course they also have a big percentage of companies with positive taxable income. If we look at the number of companies here with assessed losses, and we see 2016 to 22, well, 22 is down slightly, but here it just went up and up and up and up. More and more and more companies with assessed losses, okay? And we see the number of companies below 10 million and above 10 million, kind of tying into that earlier slide. So I think, yeah, it really warrants, I think, further investigation. The magnitude of these assessed losses, how it is that they arose, and what is the outcome? Because are we, how much tax are we kind of losing from companies that continue to trade but just have these massive assessed losses? Now, of course, there was action that was taken with the amendment of Section 21A, talking about the ring fencing of assessed losses and the set off of the assessed losses. So, you can only set off up to the greater of R1 million or 80% of your current taxable income. So that does mean that even companies with massive assessed losses possibly would still have some element of taxable income, but that's only if they have current taxable income. Okay, it depends whether they have an assessed loss in terms of just their current year's trade or not. Okay, I saw a question pop up here, but it goes back to the tax-free savings account. And it comes from Wesley. He says the 36 and the 500,000. Has there been any mention that after 14 years, once the annual limit is reached, that system will close? Well, look, it's not everybody has started contributing from the word go. Some people have only started later on. So some people will only reach the 500,000 limit, who knows, quite a lot of years in the future. But I haven't heard any mention about the system actually closing. It's going to be interesting to see what happens when we start seeing this kind of momentum of people reaching the 500,000 Rand limit. And that will be within the next 5 years. We'll see quite a lot of people reaching that 500,000 limit. It'll be interesting to see what actually happens. Will they raise the limit, or will they just let those investments sit, but no further investment taking place? It hasn't been clarified exactly what is going to happen there, Wesley. It's an interesting one. Okay, getting back to our small businesses, business tax. Small business corporations, again, totally unchanged since 2023. So we saw there's that 95,750 threshold, the same as the tax threshold for people under the age of 65. So no further change there. No further change on our turnover tax on micro businesses. This all has remained totally unchanged for the last 10 years. This was always an area that the late Matthew Lester used to drive quite heavily. And it really seems that since he passed on, and I believe it's 8 years since he passed, there's just been no one else taking up the baton. So this has just stayed as is since 2015. And the growth in assessed losses possibly due to COVID, very possibly. But many of these assessed losses and the picture of assessed losses was actually there even predating COVID. So, you know, many of these companies have built up these assessed losses over many, many years, going back even before COVID. But yes, of course, you know, the economic stagflation, as it were, the drop in the economic growth during 2020, we saw that on the earlier slide. And certainly COVID hit a lot of companies very hard. And the question is, have they bounced back entirely, or are they still trying to recover from the assessed loss they had in those years? Moving on to individuals now with the travel allowance table. Now, even though the first budget speech was cancelled and then postponed, SARS did go ahead and publish 3 important tables. The one was this table for deemed cost per kilometre, and the other 2 relate to the subsistence allowance table. So these 3 tables were all published in the Government Gazette before the end of February. So there was the certainty, and we know this is what the travel allowance table is going to look like for this next year through to the end of Feb 26. And all of these amounts pretty much have been adjusted, not all in a great way as far as the recipients of the allowances are concerned. On this next table, I show you kind of the variation from 25 to 26. And you see here that the fixed costs have all kind of gone down by 2%, fuel costs have all gone down by 3%, and the maintenance costs have gone up by 3%. So yeah, I mean, it does mean that your deemed cost per kilometre on average is going to be less than what it was last year, all other things being equal. The fixed cost, I think the rationale here is that the interest rates are down, the fuel price is down, maintenance costs are up. But it does seem to me a little bit unfair that, yeah, it might be a bit harsh, but nonetheless, that's what this allowance table is looking like. And in terms of the fixed method, the fixed rate simplified method, and this is where you pay a reimbursable allowance to an employee who travels for business purposes. You can pay up to now from the 1st of March, 476. Now that was 484. So you can see that rate has also come down compared to what it was last year. And if you pay anything more than 476 per kilometre, then the excess becomes fully taxable. All right, so be careful of that. Make sure that you adjust your travel policies, unless you want to pay R5 a kilometre and be generous, but then make sure that through your payroll you process that correctly to tax that extra amount, because that extra amount becomes taxable immediately. It's taxed under Section 7B, so it's taxed as and when the amount is actually paid. Okay, so if a person submits a travel claim today and you pay them R5 per kilometre, then that excess of 24 cents per kilometre over however much they travelled becomes taxable in this payroll period. Okay, and it's only the 476, we talk about that being a tax-free rate. It's only tax-free as long as the recipient receives no other compensation in the form of an allowance or reimbursement, no other allowance or reimbursement other than for parking or toll fees from the employer. It used to say a few years ago, used to say for that vehicle, but that wording was changed a few years ago. So that employee can get no other allowance or reimbursement other than parking or toll fees from the employer in order for this to be tax-free. Subsistence allowances, well, those have increased your daily rates, 4% increase. If you're paying for meals and incidental costs or incidental costs only, both of those have increased by 4% from the 1st of March. Of course, remember, if the person travels internationally, then we look at the SARS table that was gazetted last year. So we still use the same table, no change. These changes in the brackets here compare back to the previous table, which applied in 2019. Okay, so that was unchanged from 2019, etc. So if a person travels to France and you pay them a subsistence allowance, it'll be tax-free up to 128 euros per day because they deemed to have expended that amount. And then obviously, whatever you pay to them would have to be translated to rands. Okay, so that's the travel outside the Republic. I've just given you an excerpt of some examples of what the daily rate is there, but that hasn't changed, all right? So travel outside the Republic, it's still the same table as we used last year. Then they also have this provision for day trips where the person travels away on the instruction of the principal, etc. And we have a daily rate, which is the same as your other subsistence rate for incidental costs only, and it's gone up to 176 per day. All right, so that's that daily rate there. Then we get on to our taxes on property, as is referred to in the table on tax revenue, starting with estate duty. And now, of course, we really get into an area where there's just no change at all. So estate duty, still the same, 20% on estates. It talks about that's the dutiable value of the estate, okay? Up to 30 million is taxed at 20%, and the dutiable value exceeding 30 million is taxed at 25%. We do, of course, have the abatement, 3.5 million per person. That was last amended in 2007. So 18 years ago is when it was last changed. Now, this has to beg the question whether the policy intent at the time that estate duty was prevailing in 2007 is still maintained in the current situation when we have a 3.5 billion rand abatement. You see, if we had to say, what would the current value of that 3.5 million be? It's probably closer to 20 million if you had to take inflation into account for 18 years. That's probably going to be closer to 20 million rand. So what we would be saying in terms of today's situation, we would be saying it's only estates over 20 million on which you're going to pay estate duty. Whereas currently we're saying it's estates over 3.5 million. I mean, that's a vastly different situation. People talk about wealth taxes and, you know, we should introduce a wealth tax. And the question always is, well, what is wealth? At what would be the benchmark for introducing a wealth tax? What would you consider to be wealthy or sufficiently wealthy to pay a wealth tax? Well, that's one question for a wealth tax, but here we're saying an estate duty is a type of a wealth tax, and we're saying if you've got an estate worth more than 3.5 million, then you're going to pay this wealth tax being estate duty on that estate. Now, granted, you've got certain exemptions and, you know, obviously whatever passes over to the resident surviving spouse, you get the rollover provisions that come in there. You technically wouldn't pay estate duty on that. But absent that, 3.5 million is hardly something that you could say this person is wealthy, you know, and yet we're going to impose this wealth tax on any value above 3.5 million. This has to be way overdue for adjustment. And it ties in with so many of these other monetary amounts that are way overdue for adjustment. So we'll have to wait and see what happens. I see that SAICA did, towards the end of 2024, as part of their Annexure C proposals, they did make another detailed submission to National Treasury around these monetary amounts. They've done it before with no success. They did it again. And the feedback from SAICA was that it was quite well received from National Treasury. But unfortunately, we've seen no change. So maybe next year, we can only hope that they'll come and have a look at these monetary thresholds next year. We see the same with donations tax. You know, this 100,000 Rand exemption, unchanged since 2007, 18 years ago. So that currently should probably be in the region of 500,000. So that means, you know, only donations over 500,000 really in concept, that should be subject to donations tax. And yet donations above 100,000 are subject to donations tax. And here we've got this variable rate again, 20 or 25%. Just be careful around donations. I see that SARS has been focusing a lot on donations tax recently. They have recently put out a new guide on donations tax, and they've updated the IT 144 form. And I would venture to suggest that SARS is focusing a lot more on donations, because I do think that there's probably a lot of under recovery on donations. Many people seem completely unaware of the fact that if, for example, they give their house to their child, that would be a donation subject to donations tax. And many people just cloak everything under the category of maintenance, and they say, well, it's maintenance. It's an exempt, it's not a donation, it's exempt from donations tax. We had a recent case that came through the tax court, the Western Cape Tax Court, dealing with a doctor who had been giving substantial amounts of money to his son, who was a student, and he maintained that that was maintenance. But he was paying more than R1 million a year to his son. Now, you might say, well, you know, some people's standards of living are different. But at the end of the day, that taxpayer did not, let's put it this way, he did not discharge the onus upon him to prove that those amounts were actually maintenance. And so it was treated that SARS assessment of donations tax was correct. And I think SARS has got a bit of muscle out of that. And I wouldn't be surprised if they start putting a lot more focus on donations tax, especially as they start looking at people's assets being declared, high value taxpayers having to declare their assets and liabilities, and so looking at movements in assets, they may well pick up donations. So just be aware of that and make sure that you and your clients are aware of what constitutes a donation, how to value a donation, when a donation takes place, and how to declare the donation to SARS and pay the necessary donations tax. And if there's any issues around that, if there's been any under declaration of donations tax, that's when you would look at the voluntary disclosure process to rectify that. See, there's another question that's come in here. Let's have a look at that. Peter says, it seems there are a lot of thresholds that need review. Absolutely. You're going to see a whole lot more as we come through here, Peter. And you mentioned the VAT, the voluntary amount of 50,000 and the compulsory amount of 1 million, in addition to the CGT that we're going to talk about and so on. But the VAT, let me just make a point there, that at one stage, SARS was saying that they deliberately are not raising the VAT threshold because they would rather keep an eye on these vendors who are coming into the tax system and starting up businesses, etc. They'd rather know about them and keep a handle on them from a compliance management perspective. So when we talk about all of the monetary limits being raised, it's not a given that that would always include the VAT thresholds. Okay, so that's a separate question on the VAT. And look, none of this has been addressed. So, it all requires addressing. We'll have to wait and see. Donations between spouses are still exempt. Yes, thank goodness. All right. So that is still a situation where you have an exemption, donations between spouses. But, your other exemptions, have a look at that sort of section 56 of the Income Tax Act with the various exemptions. And be careful, because what came through with that tax case that I was talking about is the onus on the taxpayer. If you think that an amount is maintenance and therefore it's not a donation, it's not subject to donations tax, if SARS challenges you, it will be up to you as the taxpayer to discharge the onus of proving that that indeed is maintenance. The other exemptions, let's look at them from capital gains tax, and here we see the annual exclusions, etc. This annual exclusion of 40,000 Rand last amended in 2016, so that was 9 years ago. And that was when the JSE index was 50,000. I put that in there just as a kind of a basis of comparison to say, if you had a little parcel of shares, and the JSE index was sitting at 50,000, the annual exclusion at 40,000. Now the JSE index I just saw today is sitting at 87,900. So, maybe that should be sitting at least 70 or 80 or maybe 100,000 Rand. And yet it's still sitting at 40,000. The annual exclusion in the year of death, 2012 is the last time that was changed. And this affects every person who dies is deemed to have disposed of their assets at market value on the date of death, except for assets that are bequeathed to a resident surviving spouse. There you've got the rollover provisions. So there's a tremendous number of people who are being affected. Well, their estates are being affected by this, that they only get the first 300,000 exclusion, and any other capital gain is subject to capital gains tax. Another area grossly unfair, the primary residence exclusion, 2 million in 2012. So if you take it 2012 to now, 13 years, so that should be probably in the region of kind of 5 million by now, if we adjust that by inflation. And if you think about it, you're just talking about selling your primary residence. You're actually not talking about, investing in crypto or doing anything that's trying to make you rich. You just invested in your primary residence, and now you sold your primary residence probably to buy another one. Okay, so either you are changing homes as your children are changing, or you have now reached retirement age, you need to move into a retirement home, and so you sell your home. And yet any capital gain in excess of 2 million is going to be subject to capital gains tax. And then you still have to buy another home on which you pay your transfer duty, conveyancing fees, etc. It's punitive, and it's really unfair that they've left this unchanged. And then, of course, when you look at small assets as well, small business assets, paragraph 57, this was put into the tax regime to give some space to individuals who started their own businesses, built up their own businesses, and then sold those businesses to fund them in their retirement. And so this exclusion applies to people who have these disposals of small business assets when they're over the age of 55, or they're selling because of old age, ill health, or death. All right. But the thing is, although it's bad enough that the actual exclusion has not changed, what is worse is that the maximum value of small business assets has not changed since 2012. So that should probably be sitting at about 25 million by now, even more. And the thing is that if your value of small business assets has gone R1 over 10 million, then you are excluded from this exclusion, and you won't get any exclusion whatsoever. And so that's extremely punitive and unacceptable. And honestly, I think, it's really grossly unacceptable that 10 million has not changed, to at least keep people within the scope of getting the exemption. But they will get no exemption if the value of assets goes above 10 million. So that is definitely an area that needs attention. And so let's just hope that, National Treasury starts paying attention to this. If not, we need to stay on the case and just keep making petitions around this, because it's part of the stealth tax, just like freezing the tax tables, freezing the medical credits, freezing these monetary thresholds. Inflation pushes your tax situation past these thresholds, and people end up paying tax because of inflation, because of failing to adjust these amounts by inflation. Now, the CGT inclusion rates, I just put those for a point of reference. They haven't increased since 2016, and quite happy that they haven't. So that's how they are, and that shows your maximum effective rate on capital gains. One area that has received some attention is the transfer duty table. And thank goodness, I think this is one of the highlights of the budget speech, is the fact that they've adjusted the transfer duty table, because at least it means when people are buying property, the value of property has increased by 10%. So now you've got your threshold at 1.2 instead of 1.1, and that carries all the way down, all right, compared to what it was before. So from the 1st of April 2025, it was last changed in 23, so that's why they probably figured 10%, 5 plus 5 is your 2 years of inflation, okay, be that as it may. And so they've adjusted those tables. The rates stay exactly the same, but the actual table, the thresholds have changed. So I think that is a very good move. I see a question coming in here. Let's just have a quick look at that. And George makes the point, municipal valuations are most often higher, yes, than what market prices fetch, which means you get nailed on that as well, because you're paying your rates and taxes based on municipal valuations. And then when you sell your house, you sell it less than the municipal valuation. So it creates another grossly unfair situation. It's punitive, the way that these municipal valuations just go up, and yet the average price of property, certainly in places like Gauteng and many of these smaller towns around the country, the average house prices have not increased, and yet the municipal valuations carry on regardless. And then what about the value of the rand compared to the dollar over the same period? Well, that's another aspect, of course. If you have to look at the rand versus dollar, especially if you're looking at this period from 2012 to now, I mean, that's another aspect that you could take into account. Okay, let's have a look at tax incentives. So we still have a package of tax incentives. The ones I put on here are ones mainly that have sunset dates, although not all of them. And what I wanted to highlight is that the learnership allowance last year was extended through to March 27. So that's still with us for another couple of years. This year, the energy efficiency savings incentive and the 13 quat urban development zone allowance, those have both been pushed out from December 25 to December 2030. All right, so those have been pushed out. And those are really the only changes that have come through there. But talking about monetary thresholds, I put this on here to remind me to also mention that when you look at the wear and tear allowance, Section 11E, and you look at BGR 7 and the write-off periods of assets, and it tells you that if you've got a standalone item that has a cost of not more than 7,000 Rand, as long as it's not part of a set, you can write off the whole cost in year one. And that 7,000 was last adjusted in 2009. So there's another one, because this is hitting businesses, you know. So now you take an asset you're having to write it off over, say, 4 years or 6 years, you know, if it's furniture and so on. And yet, maybe that asset, maybe it was a table that only cost you 8,000 Rand, and now you've got to write it off over 6 years. Whereas if they had just adjusted the 7,000 by inflation, you know, we would have a much more realistic scenario that your smaller assets can be written off in full in year one. But unfortunately, that amount has not changed. Okay, I do want to just mention, talking about incentives, that last year they did make the announcement around this electric vehicle incentive. And so that's still on track to come in from the 1st of March 2026. Okay, and that'll be 150% allowance in the first year for new investments to produce electric and hydrogen-powered vehicles. So they didn't mention it this year, but I thought just to mention, because it is something that is still hanging over from last year. If we look at the taxes, the sin taxes, and we said here increases above inflation. Now, these increases all came into effect from the date of the budget speech. It was announced that in future, this effective date will be 1st of April. So it won't always come in immediately, but for this year, it still has come in immediately. And you can see here above inflation increases. I've just taken a selection. I haven't copied the whole table, but above inflation increases there. I should have taken multi-year off because that has increased, but I haven't shown the percentage change, all right? But cigarettes and vapes got a better deal than alcohol, because there we saw increases really just in line with inflation, whereas alcohol significantly above inflation. And that's all come in, as I say, from the 12th of March. Fuel levies, no change in fuel levies or the road accident fund levy. But what has changed, it flows through from the carbon tax legislation, is you have the carbon tax levy that increased by 3 cents per litre. So those will come in on the 2nd of April. Okay, that's going to come in on the 2nd of April. It was already set basically as part of last year's carbon tax legislation that this would come in. And so if we look at the total, for petrol, the total levy is 621 per litre, diesel 609 per litre, and that makes up 28% or 30% in the case of diesel of the current pump price. So if you think about it, yeah, it's almost a third of whatever you pay to fill up your tank in your car. About 30% of that is going in taxes and road accident fund levy, which is really just another form of tax for most of us. All right, so that, yeah, not a very happy picture, but at least I guess the happiness is that they haven't increased those fuel levies this year. The health promotion levy, there still seems to be quite a bit of movement from a certain group that seems to want to increase the sugar taxes. Yet government has said that they've decided not to increase. So what happened is that the sugar tax came in from the 1st of April 2018, and that was on 2.1 cents per gram of sugar exceeding 4 grams per 100 mils. So if you think about 100 milliliters of liquid, if there's more than a teaspoonful of sugar in that 100 mils, the excess, so the excess 4 grams equates to a teaspoon. And so if you have any extra sugar, any extra gram above 4 grams attracts this tax of 2.1 cents per gram. And then that increased to 2.21 cents in 2019. They were going to put it up again, but then that was postponed and then postponed again. And then they decided this year, they announced that they've cancelled that increase to allow the sugar industry more time to restructure in response to regional competition. Well, the sugar industry is really battling. It's basically taken a huge hit as a result of this health promotion levy, even though we've seen, of course, things like from Coke, we now have all these variations, low sugar, no sugar, etc. But nonetheless, the sugar industry has really taken a knock from this health promotion levy. And so, yeah, they've just given a bit of a respite, no further increase, okay? But the sugar tax is still there, 2.21 cents per gram in excess of 4 grams per 100. Has it made a difference in terms of making people more aware of sugary drinks? Maybe, but I'm not really sure that it's made that much of a difference. Carbon tax, of course, here's another area, environmental tax. The carbon tax was introduced to try and get a more carbon neutral production situation in South Africa, that we would move away from fossil fuels and go to this carbon neutral production. And so they introduced carbon tax in June 2019 at 120 Rand per ton of carbon dioxide equivalent. That's the emissions that come out of the business, all right? So they would measure the amount of carbon dioxide emission and tax it. And of course, since then, we've seen the rate going up and up and up. And so from the 1st of January this year, the rate is now 236. How's that for a bit of inflation, okay? From 120 Rand per ton, now 236 Rand per ton. And carbon tax was introduced in a kind of a phased process. And now we are into the sort of going into the second phase or third phase of carbon tax. And so it's something that is developing and evolving as we go along. Another announcement in this year's budget was around ad valorem. Now, there has been a bit of talk around luxury goods tax. We do have a luxury goods tax, and it's this ad valorem excise duties. So we have excise duties, specific excise duties, which is the sin taxes on beer, wine, cigarettes, and so on. But then we have the ad valorem excise duty on your imported goods, your luxury items, including smartphones. But the announcement here is that whereas normally they impose ad valorem excise taxes on smartphones at a flat rate of 9%, and that's over and above VAT, customs duties, etc. There's another 9% that's paid. So there's another tax that you pay that you probably hadn't thought about when you get your smartphone. You think about VAT, but there's also the ad valorem excise duties. But what they're going to do is they're going to put a threshold. And for anybody importing a smartphone and at a cost of less than 2,500 Rand, you won't have to pay this 9% ad valorem excise duty. Whether you can find an imported smartphone for less than 2,500 remains to be seen. All right, and then some other projects the National Treasury announced that they're going to be working on. Collective investment schemes, they've put out a discussion document in 2024 with various proposals, and they're going to continue those consultations around how to tax collective investment schemes and hedge funds, okay? And then infrastructure funding, they are consulting around unlocking institutional funding for infrastructure. You may recall that in the budget speech, it was announced that government would be investing around R1 trillion over the next 3 years in infrastructure, which is great if that translates into meaningful investment that is going to produce economic growth. Fantastic. But now, of course, this question is looking at how do we fund that? And so they're looking at various investment vehicles and to have a look to see how that would work in the tax regime. So there'll be some consultations around that. On our tax treaty network, our double tax agreements, we have quite a big network already of double tax agreements, but they're looking at expanding that. And I think more importantly, renegotiating some of those existing treaties to strengthen economic and trade relations, et cetera, et cetera. But a lot of those tax treaties have been around for a long time. And especially with the global minimum tax coming on stream, base erosion and profit shifting measures and so on, and things around transfer pricing. And, you know, the whole picture of international tax has changed quite substantially over the last 5 to 10 years. And so it's opportune probably to have another look at many of these tax treaties and just to make sure that these tax treaties are keeping pace. What is provided there, does it keep pace with what is going on in the realm of international tax? VAT on imports. Now, this is an interesting one. I'm sure you've seen SARS focus on imported items when people order goods through Temu, etc., online purchases. And they hiked the customs duty recently on some of these online purchases. But now they're looking at this de minimis exemption. So the VAT Act provides for a VAT exemption on the importation of goods valued at less than 100 Rand. Okay, which sounds, you know, as if it doesn't really mean too much. But if you think about it, it doesn't matter how much or how little you spend if you go to Pick n Pay and you buy yourself a Coke costing less than 100 Rand, you're going to pay VAT on that, right? So that exemption of 100 Rand, even though it seems very small, it's out of kilter with what happens when you buy goods locally. And so they're going to be reviewing the legislation to bring parity to the tax treatment of goods purchased online. And as many of the offshore suppliers are not registered for VAT, so that is just lost currently. And then we get on to the Annex C proposals. So these are the more technical proposals that are coming through in the budget speech. And these are amendments that affect the Tax Administration Act. Which way am I going? The Income Tax Act and the VAT Act. All right. So this is just an announcement of what is going to come as far as these legislative amendments are concerned. Many of these proposed amendments are really dealing with quite complex areas, looking very much at tax avoidance provisions, things like hybrid equity instruments and third-party backed shares and those kinds of things, typically what they have been looking at. But there are some things that will have a broader impact. So I've just identify just a few amendments here to mention that on the Tax Administration Act amendments, they're looking at addressing the trustee's role as a representative taxpayer of pre-insolvent persons, inspecting an enterprise that applies for voluntary VAT registration. That links to the ability of SARS to conduct an inspection, obviously recognizing the right to privacy, etc. It's a constitutional right. But in Tax Administration Act Section 45, it does provide for SARS to conduct inspections at a person's premises in certain circumstances. And they're looking at introducing a situation if a person applies for voluntary VAT registration, that SARS will be allowed to go and inspect that enterprise. And a very important one, and quite a contentious one, and this has been something that has been brewing over the last couple of years. If you've been looking at tax cases around the whole question of understatement penalties, you would have noticed that there's been quite a lot of tax cases where the understatement penalty has been waived on the basis that the taxpayer indeed had an understatement that gave rise to a shortfall, but it arose from a bona fide inadvertent error. And the courts were interpreting in many cases that the bona fide inadvertent error arose because the taxpayer had relied on an opinion from a tax expert. They relied on that opinion in good faith. The court considered that to be a bona fide inadvertent error, and on that basis, the understatement penalty was waived. Now, SARS in their guide to understatement penalties has always maintained a much narrower view on what constitutes a bona fide inadvertent error, that is basically just a capturing error. That's about it. The courts have taken a much more lenient view. And now it's been announced that they're going to relook at this concept of a bona fide inadvertent error, and they are going to put through legislation. And if I just jump to the slide on this, that basically they're going to say that a bona fide inadvertent error can only be linked with substantial understatement. So it can only arise, you can only use this argument when you have a substantial understatement. And that links to the table for understatement penalties in Section 222 of the Tax Administration Act. And if you think about that table, well, 222 is the actual understatement penalty, and then 223 is the actual table. And that talks about different behaviors, all right? So what behavior gave rise to the understatement? Was it because of reasonable care not taken, no reasonable grounds for a tax position, impermissible avoidance arrangement, gross negligence, or intentional tax evasion? But in the absence of any of those behaviors, if you have a substantial understatement, which as the name indicates, it has a specific definition, but it's a material amount. So if you have a substantial understatement and there's none of the other behaviors are present, that's when you're talking about that first line, substantial understatement. And so it's really just when you've got none of those other behaviors present, but you have substantial understatement, only then would you be able to argue that you've got a bona fide inadvertent error. So it's quite an interesting proposal here, and I'm sure there's going to be a lot of debate around this. We'll have to wait and see the actual wording that comes through in the draft Tax Administration Laws Amendment Bill. And these bills, no doubt, will be released in sort of July this year, hopefully, if everything's on time. And then there's quite a number of proposed amendments to the Income Tax Act, which I've listed there. I think just to go through and highlight maybe some of the main ones, this one around death benefits with retirement funds. So the issue now is that you've got these three pots in a retirement fund. You've got the pot that arose before the 1st of September, all right? And then from the 1st of September onwards, you've got your savings pot and your retirement pot, okay? And so you've got your vested, your savings, and your retirement. Now, the thing is that what's in your savings pot, if you get to retirement and you retire, what's in your savings pot could be treated as a retirement fund lump sum and taxed according to the special table, but they didn't extend that to death benefits. And so now they're looking at making an amendment to basically make sure that on death, anything that's in the savings component that gets paid out could also be taxed as a lump sum according to that lump sum table. All right, that it doesn't have to be taxed at the marginal rate. That was obviously an unintended oversight as far as that amendment was concerned. And then cross-border lump sums, quite another interesting one. This was raised a couple of years ago and then was kind of left, but now it's been put on the table again. That SARS is unhappy that in some situations, cross-border lump sums fall between the cracks, that they end up not being taxed in South Africa. Bearing in mind that when a person has contributed into these retirement funds, they have had the benefit of the tax deductions for their contributions. And the idea being that when you take money out of that fund, you'd be taxed on the either lump sum or annuities that you take out of the fund. So the thing is that if a person ceases to be a resident and they are then a resident in another country and they then take their retirement benefit out of the fund, many of these double tax agreements provide that if the person is a resident in country X, all right, not South Africa, that retirement benefit would be taxed in that country, the country where the person is resident when the amount is paid out. And so South Africa loses its ability to tax that lump sum benefit. And so they want to change this to make sure that they don't lose their ability. They want to seek to prevent the double non-taxation, especially when there's a tax treaty. This is the wording that they put into the annexure. And so they're looking at amendments there. It's going to be an interesting one. Last time it kind of just ended up being swept under the table and left, but now it's come back onto the table again. So we'll see what happens during the discussion process. And then also an important one, if you have any clients that are carrying on trades that have assessed losses. So currently Section 20A, which has been around for probably 15 years now, but this provision, of course, ring fences assessed losses, where they relate to suspect trades, etc. But it only applies when a person has taxable income above the level at which the maximum marginal tax rate kicks in. In other words, they're subject to a 45% tax rate. So very few people are actually subject to the ring fencing of Section 20A. But now the announcement is that they want to extend the scope. All right. So they want to make it apply to more than just the people who are being taxed at 45%. So watch out for that. That could have quite nasty implications for people who do have assessed losses from suspect trades, etc., as listed in Section 20A. All right, and then ordering the balance. I don't need to talk about these ones specifically. Section 42, clarifying the interest limitations in Section 23M. This has been an ongoing process. I mean, they even talk here about 2021, that they wanted to limit interest deductions. It's an anti-avoidance provision, so, you know, it keeps moving and getting changed. So they need to have further measures to clarify certain areas, they say. This is also quite an important one for some individuals. 6 Quat deals with our foreign taxes, right? And it gives relief to South African residents for foreign taxes paid on income that is also taxed in South Africa. Now, we often think about the 6 Quat rebate, but there's also a 6 Quat deduction, and that applies mainly to withholding taxes that have been withheld from income earned in another country. And that 6 Quat 1C deduction is what is under the focus here. But the thing is, if you've got somebody who's an employee and subject to Section 23M, which limits deductions available to employees, they would not be able to claim a 6 Quat 1C deduction. So there's a fairly narrow band of people that would be affected by this, but nonetheless, they are out there, and this problem has been identified. And this is actually to the benefit of the taxpayers, that they're saying that they're looking at Section 23M and possibly expand Section 23M to allow a deduction that will be contemplated under 6.1c. So that's a pleasant proposal, and we'll see what happens there. And then they might be doing some further work on Section 25B. Remember last year that they limited the flow-through principle, that would only apply to resident beneficiaries. But now they have realized that the current wording doesn't really achieve this because of the deeming provisions in Section 7. So they're going to have another look at the Act and fix up the wording there. And then exchange differences between related companies. We've got the sort of a deferral rule there that's going to be looked at. Audit certificate for public benefit organizations, just around what exactly do you mean by audit certificate? How do you interpret that? And that's going to clarify that. Employer registration under the 4th schedule, they're looking at possibly allowing a group of companies to have one nominated employer instead of every single company doing a separate registration, which must surely be a good proposal if it's going to cut down on the amount of administration. And then importantly, the ETI amendments. And so these are the wage amendments that have been increased. They're going to maintain the ETI at 1,500 for the first 12 months, 750 for the second months. From the 1st of March, notice here March, the formula and eligible income bands will be adjusted. It used to be 75%, and now it's going to be 60% of wages below 2,500. That was previously 2,000. So they've changed that because of the minimum wage increasing. This amount previously hadn't been changed since 2019. So it's quite long overdue. So that's going to increase 2.5 up to 5.5. And then the incentive value will taper to 0 at a monthly income of 7.5, whereas before it was 6.5. All right, so it's going to impact employers who are looking at claiming the ETI because these thresholds have changed. So have another look at that if you have employers with qualifying employees who maybe had stopped claiming the ETI because these thresholds were interfering. But now that the thresholds have been adjusted, maybe people can come back into the game and claim some ETI again. Just be very careful because, of course, we've had a lot of focus on ETI. If you overclaim the ETI, there's nasty penalties there, etc. But there's nothing wrong with claiming the ETI if you are entitled to it and you're claiming it correctly. On VAT, a number of amendments here, nothing too earth-shattering. So I think I've listed them all and I've given a brief overview. And I think that's probably sufficient. So we're coming in towards the end. It's almost 5 to 5, so let me just pick up on any questions here. So here's your chance. If you have a question, pop it in. Just keep it short, please. Okay, so what considerations are given by SARS to differentiate between gifts, subsistence, donations to children? So look, it comes back to a factual inquiry. You know, donations for, maintenance is intended to cover board and lodging and clothing. So the essentials of what you need. Now, obviously, you know, what some people want to walk around in versus what other people, you know, you buy your clothing from Pick and Pay Clothing or you buy it from some high-end boutique. That's not prescribed. But the thing is that it must be something that is reasonable. And remember, the onus is on the taxpayer. So you must be able to show if you are giving your 16-year-old R1 million a year to live on, you know, you would have to be able to demonstrate and discharge the onus upon you to show you that that is in fact maintenance. I hope that is, you know, again, it's very context specific and fact specific. Okay, so Shirley had a query on Section 20A for a company. Okay, it can only apply to individuals. No, it can only apply to individuals. Just read the section. It can only apply to individuals who have the maximum marginal tax rate. And Wesley, all the thresholds exemptions the same has unwittingly been one of the reasons for stagnation of the economy and low growth. Well, you know, it's just this lackluster performance, lackluster approach. And I think that just carries all the way through. The reasons for stagnation of the economy, I mean, that's a whole economic debate. I think interest rates might have a lot to do with it. And just, yeah, not a very business-friendly environment, a lot of regulation. And I think these all have fed into the lack of economic growth. But that's just my own personal view, and I'm not an economist. So economists would be better placed to comment on that. I don't see any other questions for the moment, so I'm going to end off and just say thank you very much. Let me hand back to you, Stan. I'm just about to run out of voice. But thanks, everybody, for attending, and I hope you have found this a useful and interesting session, and look forward to chatting to you again in a few months' time. Thanks then. Bye-bye.
Thank you, Jackie. It was always informative as usual. Actually, I haven't actually even booked anything in between to the next one. So you are going to, at the moment, the next presenter in 2 months' time. But that's due to it's quite a congested period the next month. But I am looking into it, so I'll see if I can get anything in between. But we'll see. We'll keep everyone informed as we make any decisions. All right, I just see a lot of people just saying thank you now in the chat and the questions.
Okay.
All right. Anything on your side, Stan, you want to say? Oh, Paul. Anything I saw, actually, Jackie. Is it just, was it just a new thing? I saw something about the charities and the 18A submissions. Is it just a new updated dates, or I wasn't?
So there were two things. So charities with 18A, they do need to submit a third-party return, yes, and then there was also the issue around the audit certificates that I was talking about earlier. But then there was also the other thing around trustees of trusts and the deadline for their third-party submission, which is, if we go back to the previous announcement, it looks like it's going to be May next year. But as I say, SAICA is intervening to try and push that out to September. But for PBOs, their deadline is earlier. So it's trusts that have the extended deadline. PBOs, it's a bit earlier than that. Yeah.
Sorry, I couldn't get back. I don't know, for some reason it wouldn't allow me back. But Danny, you summed it up. So just thanks for everybody for attending. And Jackie, as usual, a very informative, although confusing outcome. And hopefully in mid-year in May, we'll have some more clarity. So something to look forward to. But thank you again. Well prepared and well presented. And thank you.
Thank you so much. It's been a pleasure. Thanks, everybody, for being here as well. Okay.
Thanks, Danny.
Cheers, everyone.
Cheers.
Bye.